Infinity Space was established with the vision of transforming professional education in Sri Lanka by blending technology with human spirit. Infinity Learning Space is an intellectual assembly of a vibrant panel of lecturers who teach with passion and enthusiasm in a world-class digital learning platform. Infinity Space, your personal learning space. Our brand stands for professionalism and integrity, and we operate beyond financial return to nurture the next generation of professionals by providing best-in-class educational service to our nation. Infinity's integrated learning module created by a panel of veteran lecturers provides you a unique learning experience. We provide distilled essential theory from A to Z through high-quality recorded video. Our exam preparation module provides highly exam-focused content for the repeated students. We bring two-way learning by providing you the facility to request on-demand live sessions on complex topics. Infinity Platform provides you a self-learning module with auto-marked MCQs and other features. You can purchase the modules at affordable prices. Our intellectual capital is an unmatched and an unparalleled panel of highly capable lecturers who have outstanding lecturing credentials accomplished through years of experience. We invite you to learn with passion and enthusiasm with our renowned panel of lecturers. Access your personal learning space at any time from anywhere and watch any number of times until your exam day. Log into www.infinitylearningspace.lk.
Okay, welcome you all for the pre-scene analysis. This is actually session 1. So I'm going to cover up the financial reporting aspect of the paper, so which actually are 55% of the syllabus, right? So today what we are going to do is look at this pre-scene analysis in detail, right? So that is not to touch in surface, okay? So but go into details and look at what are the possible areas that can be tested in the exam paper, basically in the unseen scenario relevant to this pre-scene, right? Right. So before moving to the accounting standard, because today in the first session, what I'm going to target is mainly the accounting standards, right? So the second session, that is a follow-up session. In the second session, I'm going to target mainly the consolidation related areas, right? Okay. So before moving to the what you call the technical aspects, giving a brief about the company. I know that you already read the pre-scene number of times, but giving just a recap. So the company that we need to look at here, or the given company, is Ceylon Ayurvedic Private Limited. So the abbreviation we used is CAPL. So they are in the business of manufacturing and selling healthcare product, Ayurvedic pharmaceuticals, herbal beauty products, oils, and beverages. Okay. So the chairman and the managing director, Saman Herath. So he's actually Ayurvedic doctor, 75 years age, right? So if you look at the locations in which company operates, so the head office is in Kandy, Central Province. Then agriculture plots of lands. There are a couple of agriculture plots of land to grow these plants, herbs. So those are in Kandy and Paduka. So they have the main factory in Kandy, right? And the second factory, another factory in Paduka. So whatever the items which are planted or grown in these lands is processed in these two factories, right? Kandy and Paduka. Then looking at the staff, they have nearly 500 staff, right? Out of that, nearly 100 staff is in executive category or above. So thereafter, initially this has been started as a manufacturing and selling manufacturing company, but very recently today, company has become a research-oriented company, right? To cater the requirements of the customers, company wants to move into the quality products. So they have moved into a research-oriented company. So with that intention, what they have done was they have set up a state-of-art research and development center in the financial year 21-22, right? So this is actually a brief overview about the company. Then, so what their plans, future plans are, so they are trying to expand both locally as well as globally, right? So that's why in the pre-scene, it was mentioned that they are planning to appoint 5 new distributors, right? 5 new distributors, as well as they are planning to have 13 company-owned retail outlets in the next 5 years' time, right? That is the expansion that they are focusing in terms of the local environment, and with the growing demand in overseas market, they want to expand in overseas as well, right? Then if you look at the shareholding structure, right? So the company has issued in total 8 million shares. So per share price is 12.50, right? So 8 million shares, 12.50. If you look at the total value of the stated capital, that is 100 million. Then there are 4 shareholders. Saman Herath, he is the founder and the current chairman and MD, is holding 40%. The Ruwan Herath, that is actually son of Saman, is holding 20%. And as per the pre-scene, Ruwan is looking at the agricultural and the operational aspect of the company, right? Then Saman's daughter, Hansini Herath, she's also holding 20%, and she's the one who is looking at the marketing side and the business development side, both locally as well as overseas. Then there's an institutional shareholder, Blue Rock Capital. They actually acquired 20% from Saman in the financial year 2021. So the Blue Rock Capital acquired 20%, okay, shares of this company from Saman. But as per the pre-scene, actually, company is having, this particular company, CAPL, is having an intention to issue more shares to Blue Rock Capital. So the Blue Rock Capital shareholding will be increased in the future, where there would be a dilution in the family holding. At the moment, if you look at, family is holding how much? 80%, but we are expecting a dilution in next financial year, that is 22-23, with the company issuing additional shares to the institutional investor, Blue Rock Capital, okay? Then if you look at about the Blue Rock Capital, so as mentioned earlier, so Blue Rock Capital acquired shares in 2021 from Saman, right? So the Blue Rock Capital is focusing on including the sustainability into the business strategy. So that's why they are focusing on this ESG aspects, that is environmental aspect. What is the organization viewpoint about the environmental matters, global climate, okay? So then social aspects, how the company is treating their stakeholders, are they caring about all the stakeholders, okay? Social aspect. Then the governance aspects, internal controls, right? Leadership. So these aspects are kind of top priority for this institutional investor, right? So then institutional investor intimated to list CAPL in the Dirisavi board, right? So they want to push the company to list in Dirisavi board. Actually, for this, as per the pre-scene, someone also agreed. That means, so might have been in the unseen, so you'll be given the information about the company listing. I hope you know what is Dirisavi board. So you have the main board, right? So that is the, so to list in the main board, at least you need to have 500 million worth of stated capital. So in the Dirisavi board, you need to have at least 100 billion. In this case, companies having 100 million, right? There are other requirements as well. Like in the Dirisavi board, you need to have 10% public holding and 200 shareholders. How to do that is a question mark at the moment. Okay, 10% public holding and 200 minimum number of shareholders. In addition to that, company should have a positive net asset position to list in the Dirisavi board, right? So, so in addition to main board, Dirisavi board, there's something called empowered board as well. That this empowered board is for the small and medium type investors, right? So SMEs. Okay, so so that is the information what it was given about the company in the pre-scene, right? Now, what we are going to do now is to look at each and every aspect of the pre-scene with what is the applicable standard and what is the accounting treatment as per that standard to the given scenario in the pre-scene. So up to now, did you all understand, and do you have any questions? If you have any questions, please use the chat box. At the end, we'll have a discussion, but by the time being, so use the chat box. If you have any questions, you can raise, okay, then and there. Are we clear up to now? make the session interactive, right? Are you clear at the moment? So company overview, okay, right, great. So then CAPL owns, so first information, CAPL owns many agricultural plots of land in Kandy and Padukka to cultivate herbs. So these are actually extracts. What I have mentioned or what I have shown here in purple color is the extracts directly from the pre-scene, okay? And also it was mentioned that cultivation of medical plants is carried out in the Western province and Central province. Western province means actually in Padukka, Central province means in Kandy. So you know that what is the applicable standard here? LKS 41 agriculture standard. LKS 41 agriculture standard. So now, so this standard has not been tested for a while actually, right? If you look at the agriculture standard, an examiner can construct a very good question out of this area, right? I'll tell you why. Let's look at a bit of the theory relating to this agriculture standard. What the standard says is you should clearly understand what is the scope of this standard, what is the scope of LKS 41. So what specifically mentioned in the standard is, so this standard talks about three things. It covers three things. So these things should be relating to the agricultural activity. There should be an agricultural activity. So in this case, there's an agricultural activity because why? There are plants, right? So the medicine plants, Ayurvedic plants are grown in two lands, which are belong to the company. So if you have any biological assets, what are the biological assets? Can anybody tell me? A living animal or plants, right? So the things like, let's say, when it comes to animal, it can be a calf, cow, sheep, biological asset. Elephant is a biological asset. Then plants, it can be a mango tree, it can be a herb, it can be a tea plantation. So all these things are what? Biological assets. It covers the biological asset as well as agricultural produce at the point of the harvest. Very important point. It covers agricultural produce only at the point of harvest. That's why I said that examiner can construct a very good question out of this standard, right? Now, if I take a simple example before moving here, let's say you have a fruit tree, mango tree. Your intention is to take a mango out of this tree. What you did was, or what you are doing is, let's say at the time of harvesting the mangoes, at the time of the harvesting of the mangoes, so what is the applicable standard? LKS 41. But let's say after you harvest these mangoes, you put them into a basket or you store them. At the time you put them into a basket and you store them, LKS 41 is not going to be applicable. Why? That is an agricultural produce. That is after the point of the harvest. After the point of the harvest, what is the standard that is going to be applicable? LKS to inventory. Did you understand the difference? So the not IAS, our version is LKAS. LKS 41 is applicable for all the agricultural produce only at the point of the harvest. If I take another example, let's say a tea plantation. Right, in the tea plantation, you at the time where you are taking the tea leaves out of the tea bush, okay, at the time of picking the tea leaves out of the bush, you can say that that is the point of harvest. At that point, what is the applicable standard? LKS 41. Then after you take the tea leaves, you keep it, you process it, and you produce the packeted tree. So after the point of the harvest, what will happen is these would become inventory. LKS 2 is the applicable standard. I hope you understood about it, right? Clear. Then, not only that, LKS 41 is applicable for the government grants, right? Government grants that are relating to the biological asset, very important, that are measured at fair value, What does that mean? That means, there's a separate standard for the government grants. Am I correct? LKS 20, accounting for the government grants and disclosure of government assistance. So that is the standard which is applicable for the government grants. But the standard specifically mentioned that if there's a government grant with regard to a biological asset, you know what is biological asset, living animal or a plant, not only that, these biological assets are to be measured at fair value, then what is the applicable standard? LKS 41. Right? Let's say you receive a grant in relation to your tea plantation. Okay, you receive a government grant in relation to your let's say you have a fleet of cows, and let's assume a place like Ambewala, that is a good example for a agricultural activity. So if you receive a grant in relation to that, and if you measure your biological asset at fair value, applicable standard would be LKS 41. But let's assume you have the biological asset, you are not measuring them at fair value, you measure them at cost. Okay, you measure them at cost. If it is measured at cost and where you receive a government grant, what is the applicable standard? LKS 20 normal government grant standard. That is the difference. So you need to be careful, right? I hope you understood about it, right? So these are the items which are covered by the standard. Then you also should know that what are the items which are not covered by the standard, right? So what are the scope outs? These are the scope ins. And what are the scope outs? Scope outs are this, very important. When you have a land to carry out the agricultural activity, normally to carry out an agricultural activity, you need to have a land, right? Without having a land, you can't carry out the agricultural activity. But you should understand, accounting for that particular land is not covered by LKS 41 because that particular land is a property, plant and equipment covered under LKS 16 property, plant and equipment standard. Okay, right. Then sometimes companies using intangible assets in relation to the agricultural activity. Let's say there's a license that you acquired, right, to carry out the particular agricultural activity. Everyone can't carry out the agricultural activity. There's a limitation. So somehow or the other, you got a license to carry out the agricultural activity. So you have a legal right or protection with regard to this license. So then what will happen? That particular license is considered to be a intangible asset. So if it is an intangible asset, yet again, how to account for that license is not covered by LKS 41, that is covered by LKS 38 intangible asset standard. Are we clear? Right? Okay. Thereafter, I already mentioned about this one, agricultural produce after the harvest. Okay, now you have trees, and once you pick the item out of the tree, then you have to maintain those, you have to store those, and you process those items. So after the harvest, what is going to be applied is inventory standard LKS 2, right? Finally, this is very important one, bearer plants. Now, by the time being, when you hear me, what you would think is, okay, I explained here what is biological assets. I told you living animal or plants. Biological asset means living animal or plant. Then the idea that you get is, when it comes to the word plant, okay, all the plants are accounted under LKS 41. No. Now I'm going to explain you one important thing. So that would be important even in the case of the unseen, right? When it comes to the plants, let me write there, you have two types of plants, right? One is bearer plants. The other one is consumer plant. Some people call this as non-bearer plants, consumer plants, or some people refer this as non-bearer plants. Right? What is the difference between these two? Bearer plants means it produces the agricultural produce more than once. Now, if I take a simple example before moving to this particular example, let's say if you have a mango tree would produce mango more than once. Okay, every season it produces mango. right? Tea bush will produce tea leaves number of times, right? Another example, grape wine. Grape wine will produce grapes number of times. So that is a what? Bearer plant. So it produce agricultural produce for more than once. So the accounting for the bearer plants, right? Accounting for the bearer plants are not covered by LKS 41. Actually, when you have bearer plants, those bearer plants are property, plant and equipment. Do you get my point? So accounting for this is covered by LKS 16. 16. This is a PP&E. Got it? On the other hand, there can be, this is another important point. Now the bearer plant is not a biological asset. It is a PP&E. But the unharvested produce of the bearer plants. Now let's say on the mango tree, there can be unharvested mangoes. On the tea bush, there can be unharvested tea leaves. On the grape vine, you can have unharvested grapes. Those unharvested produce of the bearer plant are considered as agricultural produce that is coming under LKS 41 standard. Did you get my point? Did you get my point? So if I read it first, now if you read it, bearer plants are used to produce agricultural produce for more than one period. Example include grape vines or tea bushes. Same examples that I have given. Bearer plants are accounted in accordance with LKS 16, property, plant and equipment. Up to now clear? No? Thereafter, however, this is the point, any unharvested produce growing on a bearer plant, such as grapes on the grape vine, is a what? Biological asset. That is a biological asset. Grapes on the unharvested grapes on the grape vine, then unharvested tea leaves of the tea bush is considered to be a biological asset. So it is accounted under LKS 41. I hope you are clear about it. Are we okay with that? Right. That is about the bearer plants. Then the other category is consumer plants. So the difference here, in the case of the consumer plants, you consume the tree itself. Example, let's say I am growing trees to take the timber, okay, to manufacture furniture out of this timber, right? So then what you consume is the particular tree, teak, let's say mahogany. You grow these trees to consume the tree itself. So those are consumer plants. So the accounting for the consumer plants are covered by LKS 41 because that is a biological asset. This is a biological asset. Are we clear with that? Did you understand this? So in your unseen, because as you have a lot of as you have a couple of agricultural lands, on these agricultural lands, certain plants produce agricultural produce for more than once. You don't consume the plant. In that case, those plants are bearer plants accounting as per LKS 16, property, plant and equipment, but the unharvested produce of that particular bearer plant is a biological asset under LKS 41. On the other hand, in certain instances, you might consume the plant itself, those herbs itself. So those things are biological assets because those are consumer plants. Accounting for such is covered by LKS 41. I hope it's clear now. So this is a possible area because examiner can construct a, I would say, a beautiful question out of this. Why do I say that? You can give the information about the agricultural activity there. There's a land. So the company has taken a license to carry out this particular agricultural activity. So thereafter, so some bearer plants, some consumer plants. Then at the point of harvesting, when you are harvesting the agricultural produce, LKS 41 is applicable. But after the point of the harvest, it's no more a biological asset, it is inventory. LKS 2 is going to be applied. So that's why I mentioned that can test a good question. And it has not been tested for a while. Okay, right. So these are few examples, right, with to understand the scenario, because I'm spending a bit of a time here because this is important. So I have given different examples to understand. Let's say if you have a dairy cattle, that dairy cattle is a biological asset. What is the agricultural produce that the dairy cattle produce? Milk. Okay, milk is the agricultural produce. When you take the milk out of the cow at the point of the harvest, IAS 41 is going to be applied. Then after that, this milk would be taken into a, let's say, a basket or into a storage, and it is getting stored, and the finished product that's going to be produced would be cheese. But you should understand, after the point of the harvest here, after the point of the harvest, so these milk as well as production them into cheese would be covered by LKS2 inventory standard. Okay, so LKS 41 is applicable for the dairy cattle as well as for the milk agricultural produce only at the point of the harvest. So similarly, if you have fleet of sheep, so the sheep is a biological asset. What is the agricultural produce? The wool, right? So at the time of taking the wool out of the sheep, what is applicable? IAS 41. After that, after you take out the wool and store it and produce yarn or carpet, so thereafter, again, it is inventory under LKS2, right? So similarly, if you have pigs, so the biological asset, pigs is a biological asset, then pig would produce carcass at the time of harvesting. Again, LKS 41. LKS 41, even though I use the word IAS and LKS, it is the same thing, right? So IAS is the international version, LKS is the Sri Lankan version, right? So carcass is the agricultural produce at the point of the harvest, LKS 41. After that, it is inventory. So that means these carcass would be utilized to produce sausages or the cured ham. If I take an example of a plant, I told you earlier, let's say you have trees in a plantation forest. So you grow trees to take timber, right? What is the agricultural produce there? Fell trees. At the time of falling down, at the point of the harvest, what is the applicable standard? LKS 41. Thereafter, these trees would be used to produce logs or lumber, that is the finished product. So after the point of the harvest, LKS2 is going to be applied. So these are a few examples to understand the concept. Okay, understand the concept. And the last point what I wanted to mention here is the measurement of the biological asset. Can anybody tell me as per LKS 41? So you should answer to this question. Now we understood. So these are the things which are getting covered under LKS 41, right? These are the things which are getting covered under LKS 41. Can anybody tell me what is the initial and the subsequent measurement principles of the biological asset? Can anybody tell me? Hurry up. What is the initial measurement and subsequent measurement of the biological assets? Right, so fair value, initial measurement, not at fair value, fair value less cost to sell. Fair value answer is correct because sometimes selling cost is 0. But what I'm telling is it has to be measured at fair value minus selling cost. If you have any commissions, brokerage payments to be made when selling, those has to be deducted. Similarly, biological assets are subsequently measured again at the same measurement basis, that is fair value less cost to sell. So both initially and the subsequently, these are getting measured at what? Fair value less cost to sell, both initially and subsequently. Okay. So what about the agricultural produce at the point of the harvest? At the point of the harvest, how do you measure the agricultural produce? Let's say you are taking the grapes out of the grapevine. You are taking the tea leaves out of the tea bush. So how do you measure that? Again, same measurement basis, fair value less cost to sell. Okay, fair value less cost to sell. Thereafter, so this is actually recognition of the agricultural produce. Initially recognize the profit in the P&L, right? Because these value changes are taken to the profit and loss. Now, if I take an example of the agricultural produce, once you take the tea leaves out of the tea bush, so you have the tea leaves. You measure these tea leaves at fair value less cost to sell. So how do you recognize that? You debit to the agricultural produce where you should credit. You should credit that to the P&L. Immediately a profit. Okay, debit agricultural produce, credit P&L. Even in the case of a biological asset, right? Even in the case of a biological asset, what you do is you measure it initially and subsequently at fair value less cost to sell. Fair value changes are taken to the profit and loss. So then this initially measured fair value less cost to sell of the agricultural produce would become the initial cost for the inventory valuation, because after the point of the harvest, it is inventory, no? LKS2. Now LKS2 standard says that inventory has to be initially measured at cost. What is cost is this amount what you recognized as the fair value less cost to sell would become the deemed cost for the initial measurement of the inventory, right? Thereafter inventory standard, subsequently inventory has to be measured at cost or net realizable value, whichever is lower, right? I have given a brief, right? This is the maximum which I can tell you with regard to LKS4 because we have a lot to do. So once I discuss these areas, if you understand, that's great. If you don't understand, now you know what to do. Go back to your theory sessions. You have the recorded videos with you. Look at these sections carefully, right? If you understood 100%, that's fine. If not, you know that, okay, this is something which I need to revise by myself. Is that okay with you? Right, great. Moving on. Now the first area of the pre-scene now we looked at. Okay, first area of the pre-scene we looked at. Then the second information or the second area I would look at. So yet again, I'm reminding you what I have included in the purple color are the things which is directly extracted from the pre-scene. Okay, otherwise I have to switch here and there, right? So with the PDF and the PowerPoint, what I did was everything I have taken into a PowerPoint presentation without any disturbances. I can discuss and we can utilize the time more effectively, right? Today, the company has become a research-oriented company. Because earlier it was just manufacturing and selling. Now they want to move to the next stage, right? Research-oriented company. So for that purpose, what this company has done was they have set up a research and development center in the current financial year 21-22. This center was set up to develop new products to meet high quality standards required by the customers. Then there's a important point that you note down. Okay. Auditor has raised concern about capitalization of research and development expenditure related to the research and development center. You should know what is the correct accounting treatment for the research and development cost. So what is the applicable standard, guys? This is one of the another prominent area in the question, which can be tested in the unseen. LKS 38 intangible assets, right? So, when it comes to an intangible asset, okay, let me ask this question. So use this opportunity not only to, get to know this pre-scene, sometimes to gather knowledge, which is important for the other areas of the exam paper, right? Let me ask this question. What are the ways where an intangible asset can be generated by an organization? How many ways an intangible asset can be generated by an organization? Who can answer? How many ways an intangible asset can be generated by an organization? Hurry up, quickly. What is the answer? 3 ways, right? 3 ways. What are 3 ways? You can separately purchase. Somebody is having a patent, you buy from that person. You paid him and you acquired that patent. Then you can use that patent for a number of years, separately acquired, right? That is number 1. Number 2, business combination. When parent company acquires a subsidiary, that particular subsidiary might have certain intangible assets which might have not been recognized in the subsidiary's individual balance sheet, but for the consolidation purpose, what parent is going to do is parent is going to recognize those intangible assets, provided those intangible assets are identifiable. Example, let's say subsidiary is having a brand which is internally generated by the subsidiary. So as it is internally generated, it is not in the subsidiary's books, but it's a valuable brand. So where parent company acquire this subsidiary, for the parent, for the consolidation purpose, it is no more a internally generated brand. For the parent, it is a purchased brand, provided parent can say that that particular brand is identifiable, parent has to recognize that brand in the consolidated statement of financial position. That is the second way of generating intangible asset into a business. What is the third way? This is what it is: internally generated intangible assets, right? So normally what we say is, okay, if there are any internally generated intangible assets, we are not going to recognize those in the statement of financial position. But we know that if we can identify this is a particular internally generated intangible asset which has this research and the development phase, certain costs that you incur, you can capitalize as a intangible asset. Are we clear? Right. Then what is research? What is development? Research means you are doing a investigation. What is it? It would be a original and planned. Original means what? First time, nobody has done it. Okay, it's your own work, not something has been done by somebody else in the before. No, original and planned investigation, right? Undertaken with the prospect of gaining new scientific knowledge and understanding. To get or to find out new knowledge, new understanding, you carry out a original and plan investigation. Example, you are producing certain Ayurvedic medicine. Now you want to find a medicine for a rare disease. So what you do, you carry out the investigation activity, right? So that is what research. Now, when you carry out these investigations, you don't know whether your outcome would be a positive one or negative one. You never know. It can be positive, it can be negative. It is uncertain. As it is uncertain, what do is the cost or the expenditure that you incur in the research phase, you are not going to capitalize, you need to charge them to the profit and loss statement. So that is the accounting treatment for the research cost. Are we clear? Research cost is expense to the P&L. On the other hand, what is development? Development means application of research findings, right? So now let's say if I take the example, you do research work and you find out this is the formula that I need to have this Ayurvedic medicine to address this disease. You find out the formula, but you can't go and present the formula into the market, right? You have to make it to a commercially viable product. Okay, so that process would take some time, converting this formula into a commercially viable product. It can be a device, it can be a product, it can be a process. It has to be something commercially viable. You can present it to the market. So that is what development. Now, in the case of the development, you see that you have some sort of a certainty. So because of that, the cost what you incur in the development phase, you can capitalize as an intangible asset, provided 6 conditions are met. Provided 6 conditions are met. Is that clear? So if examiner is silent in the examination about these 6 conditions, then the assumption is these conditions are met. Did you get my point? Sometimes examiner is silent whether these conditions are met or not. There you assume that it is met, right? Okay, so what these 6 conditions are? Okay, before moving there, so this is the presentation in the diagramic form. If you incur any expenditure in the research phase, investigation phase, you have to expense that to the profit and loss statement. Then the development phase cost, you need to look at whether the recognition criteria are satisfied. If the recognition criteria are satisfied, you can capitalize as an intangible asset. Even the cost incurred in the development phase, if the recognition criteria are not fulfilled, then you have to charge that to the profit and loss statement, right? Sometimes you can't segregate, you are not clear whether this is research phase or whether this is development phase. You can't segregate. In that case, what you do is, based on the prudence concept, if it is not clear, charge everything to the profit and loss statement. So there can be a question from this area, right? So because in the paper it was highlighted that at the very at the latter part of the pre-scene, new CFO appointed, Prasanna Pereira, he pointed out that the number of mistakes in the accounting treatment applied by the organization. Okay, and also that is So certain mistakes are evident in the financial statement itself given in the question. I will highlight that right at the latter part of my session. Right. Okay. Then quickly look at what these 6 recognition criteria are. Right. So what these 6 criteria. So I'll tell you an easy way to remember. So all of you learned economics, right? In economics, what are the 2 main concepts that is discussed throughout? Demand and supply. Demand of a product, supply of a product. So you can use that concept to remember these 6 criteria. That is, to have a product demand, what are the conditions to be fulfilled? From the customer side, to have a product demand, what are the conditions? Number 1, there should be an intention to buy the product. Number 2, there should be ability to intention. Intention should be there, and as well as you have the ability to buy the product. You have the purchasing power to buy the product. Now, what I'm telling is within these 6 criteria, you have these 2 things included. There's no relation to this with demand or supply or with economics, but easy way to remember. Now think about my example, what I have given. Now let's say you want to have a medicine, Ayurvedic medicine for a particular disease. At the end of the research phase, you find out this is the formula that I need. Now what you should do, you need to convert this formula into a commercially viable product. Now for you to do that, you should have an intention to complete this activity, right? If you don't have an intention to complete the development activity, no point of capitalizing the development cost. So here, intention to complete the intangible asset, right? Similarly, you should have the ability, right? You should have the ability to do that, ability to carry out the development process. Are we okay with that? So these 2 things are there. Thereafter, on the supplier side, what is important? Customer side demand. Again, going back to the economics, supplier side supply. To satisfy the supply of a product, what it has to be there? Again, 2 conditions, 2 things. Supplier should have resources to manufacture or to produce this product, as well as supplier should have the technical feasibility to carry out the production activity. Here, those 2 conditions are also there in this list, right? Again, I'm telling you, there's no relation with economics and this, right? I'm telling you an easy way to remember only. If you look at this one, adequate technical, financial, and other resources are there to complete the development. Let's say you have the formula. If you don't have financial resources, if you don't have the technical resources, required machinery to carry out the development activity, no point of capitalizing the development phase cost. Similarly, supplier side, you should have the resources, as well as to supply the product, he should have the technical feasibility. He should have the correct technology to supply the product into the market. Here also, technical feasibility of completing the particular intangible asset. Yet again, to carry out the development activity, I should have the correct technology. Without having the correct technology, I can't convert this formula into a commercially viable product. You got what I said? Now I told you 4 conditions. What are the 4 conditions? What I'm discussing. So for you to capitalize the development phase cost, what the standard says is you need to fulfill recognition criteria. There are 6 recognition criteria. Now we understood 4. Intention to carry out the development activity, ability to carry out the development activity. Then you should have enough resources to carry out the development activity. You should have the technical feasibility to carry out the development activity. This technical feasibility is one of the important aspects actually, right? So whether you have the correct technology to convert the formula into the product. The other 2 are general recognition criteria for any asset. Tell me, what are the general recognition criteria for any asset? Future economic benefits are probable. Cost or the value can be measured reliably. Here, particular intangible asset should generate probable future economic benefits. Ability to measure the expenditure. You should be able to measure it. Future economic benefits are probable and cost can be measured reliably. If all these 6 criteria are satisfied, you say that the cost what you incur in the development phase, you can capitalize as a intangible asset. Are we clear with that? Are we clear with that? So easily examiner can again construct a question out of this area as well. Are we clear? Okay, now in this particular, now going into detail in depth of this pre-scene, it was mentioned that certain mistakes have been already done in the accounts. I'm asking you this question. Let's say this particular company mistakenly, without knowing this principle properly, what they have done was certain development cost they have charged to the profit and loss statement mistakenly. Now let's say this CFO new guy has come into the picture. He highlighted the issue, and now what he wants is he wants to again capitalize this development cost. He wants to again capitalize this development cost. Can he do that? So the development cost which has been expensed in the past, now he has understood it's incorrect. He wants to capitalize them. Can he do that? No, because why? It's specifically mentioned in the standard. What is mentioned in the standard? Development expenditure recognized as an expenditure in the P&L cannot subsequently be restated as an asset. That is out. You can't do that. Can't help. Gone is gone. Right? Got it? Then thereafter, you should understand, okay, we know now the cost what you incur in the development phase, you can capitalize. Let me ask this question from you. Cost, again, I'm repeating the statement, and thereafter I'm going to ask a question from you. The cost what you incur in the development phase, you can capitalize. Tell me what is the starting point of the development phase. You should understand what is the start and end of the development phase, no? Because during that period, if you incur any cost, you can capitalize. What is the starting point of the development phase? Hurry up, quickly tell me. Hurry up, guys. We have 6 hours only. Today, 3 hours, and in the next session, another 3 hours. So we have a lot to analyze, right? All possible things, what can be tested in the examination, we need to look at. What is the starting point of the development phase? At the end of the research phase, right? When the research phase is over, development phase starts. So that is our starting point. What is the finishing point of the development stage? What is the end? Once the commercial production starts. So basically you should understand, okay, when you are capitalizing the development cost, right, you should stop capitalizing the development cost once the commercial production begins, right? So then it's no more a development. It now generates you the economic benefits. So the total amount what you capitalized as the development phase cost, thereafter you need to amortize to the P&L during the useful life of the particular internally generated intangible asset, right? That has to be the way that you are accounting for the research and the development cost. Are we clear with that? Any questions, guys, from this area? You have any questions? No? Right. Okay. Then let's move to the okay, very good question. What is it? If I go back, now I was telling that you can capitalize the cost what you incur in the development phase. Now, during the development phase, there's no expenditure that is charged to the P&L because you start the amortization only once the commercial production starts. Up until you start the commercial production, you don't amortize. Now, then there can be a situation where you are overstating the asset value. What do you mean by overstating the asset value? You are capitalizing everything. There is no amortization during the development phase, right? There can be a situation of what? Overstating the asset value. So what the standard says is there's another standard, LKS 36 impairment of asset standard says, normal criteria is you carry out the impairment testing. Only if when you have an indicator. Now, let's say if you have an asset You have an internal indicator like physical damage of the asset, or external indicator like changes in the technological environment, regulatory environment, which has a negative impact on the asset. Those are the indicators. When you have the indicators, you do the impairment testing. Impairment testing means you compare the carrying value with the recoverable value. But in that standard, they have given 3 exceptions. That is, there are 3 items which are subject to the annual impairment testing, even though there are no indicators. Irrespective of the availability of the impairment indicators, there are 3 items which has to be tested for the impairment on annual basis. What are these 3 items? Can anybody tell me? Number 1, cash generating unit to which goodwill is allocated, because goodwill is not amortized. Number 2, intangible assets which has indefinite useful life. Intangible assets which has indefinite useful lives are not getting amortized. Number 3, intangible assets which are not yet available for use. What does that mean? Intangible assets which are not yet available for use. What does that mean? Intangible assets which are capitalized as development cost, not yet available for use. So it is not getting amortized, so that every year end check whether it is impaired. At the year end, look at what is the total carrying value of the development cost, what it has been capitalized. Compare that with the recoverable value and see that whether there's an impairment. Are we clear with that? So the examiner can actually combine this with a impairment testing as well. Likewise, thank you very much for bringing that point, right? So when you figure it out, something, because it is an open question, right? It can be anything. So this is based on the analysis what I have done. I figure it out. Okay, these are the possible areas. Likewise, if you have thoughts in your head, don't keep that in your head. Put that onto the table. Then we can discuss, right? Okay, then you are helping to the others as well. Okay, great. So the initial value of the particular internally generated intangible asset is, in this situation, the capitalized cost of the development phase. Okay, total amount of cost capitalized in the development phase. Right, great. Moving on. So all these things I explained. Next information. So sometimes I'm not going to read each and every point because I discussed, right? I discussed, now if you look at the last point, development expenditure should be amortized over its useful life as soon as the commercial production begins. If I discuss a particular point, sometimes I might not read it, but definitely I discussed, right? So let's use this 6 hours effectively as much as possible. Got it. Right, moving on to the next area. That is another information in the pre-scene. Okay, read this by your own and tell me. Okay, so what you do, read this part by your own. So this is what is learning is. Now you know how to analyze it, right? So tell me all possible standards that can be tested here. All possible standard, right? Not one, it can be multiple number of standards. Tell me, read and tell me. We'll see who will come with all. Sometimes you might say the stuff which I know, which I even not identified. Let's see. So hurry up, quickly. Hurry up, guys. It's not only LKS 37. Think innovatively, right? Creativity is important in the case of the pre-scene analysis. Okay, so okay, LKS 37 and LKS 38, LKS 10. What else? Right, okay. Company plans to implement a total quality management system due to complaints and some product liability claims filed by few customers. Right, what has happened was complaints complaints and product liability claims. There are few legal cases pending in courts according to the company lawyer. Here, few legal cases pending. Okay, pending. Then the decision can be given after the year end, before the financial statements are authorized to issue. Obviously, you have an implication of LKS 37 provisions, contingent liabilities, and contingent assets. And as well, so together with that, there can be a situation where events after the reporting date would be tested. So then recently, few workers employed by the manpower agencies complained to HR department that their statutory dues had not been paid by the manpower agency. Statutory dues had not been paid. Right? So as per the pre-scene, companies using actually two manpower agencies to carry out their packaging operation. Right? So there are employees who are actually employed under these manpower agencies. Their statutory dues like EPF, ETF has not been paid by this manpower agency. Right? Then the unlicensed software usage. So if it is, so this can be an issue which will lead to future litigation. Right? Unlicensed software. What else? Okay, so these are the answers. You have the answers in the screen now, right? Recent audit carried out by Central Environmental Authority. Actually, going concern is relating to this one, right? Recent audit carried out by Central Environmental Authority revealed that there are few issues related to waste disposal. Then CEA has given the company 6 months to rectify the issue, failing which the license to operate may get revoked. Problem has been aggravated due to the few protests against the company organized by the villagers living in the vicinity of the factory. Okay, right. So obviously, so thank you very much for the answers given. Some correct answers were there, right? So basically, what you need to understand is now with regard to the first point here, company has a clear liability. Company has to ensure that the product that they manufacture is good for the people. If there are any issues, people get sick or diseases because of the products manufactured by the company, so then they can take legal actions against the company, right? So clear risk is there. So the applicable standard would be LKS 37, provisions, contingent liabilities, and contingent assets. In addition to that, so as I mentioned, certain legal cases are pending at the year end. So sometimes the court decision would be given after the year end, before the financial statements are authorized to issue. Then there's an impact on the events after the reporting period standard, LKS 10. Okay, LKS 10. Then thereafter, this particular manpower matter, now you are employing certain manpower staff. Now you might say that, so I am not the one who has employed these people. So they have been recruited by the manpower company. So the manpower company has given these employees in terms of outsourcing to me. What I do is I make the payment to the manpower agency. So basically manpower agency, and I have a contract. According to that contract, so it was clearly mentioned, I'm paying this much of amount to the manpower agency on monthly basis. So then what manpower agency has to do is manpower agency has to pay the salaries to these people, and manpower agency has to remit whatever the statutory dues to the government authorities like EPF board and ETF board. It's not my responsibility, but you should understand they are working for you, your company. So they are there in your factory. So you can't say that your liability is over once you remit, amounts to the manpower agency, right? There can be a situation where you are also responsible not paying their statutory payments. Yet again, that would result legal claims, and applicable standard would be what? LKS 37, provisions, contingent liabilities, and contingent assets. Similarly, if you use unlicensed software, there can be litigations where you need to make payments. For that even, you need to recognize liabilities, and you may need to disclose this as contingent liabilities. There's a risk. So again, LKS 37. Then with regard to this particular situation, now Central Environmental Authority specifically mentioned that, okay, there are issues with regard to the waste disposal. Company is not following the correct practice. So they give you time for 6 months. If it is not rectified, license to operate may get revoked. You can't operate. Your going concern ability is questionable if you don't make the remedial action during the 6 months period. Right? So there's a legal issue that can be so severe you can't continue your operations. So the going concern concept discussed in LKS 1 is going to be applied. Okay. And not only that, this is the hidden one, LKS 16. How can LKS 16 is going to be applied here? How can LKS 16 is going to be applied here? Can anybody tell me? Company now to maintain this license or to operate in the long term, company might need to invest in environmental and safety equipment. Those can be considered as long-term assets within the business. There can be a question, companies investing in certain drainage system, or company wants to put up chimneys to release the toxic air to the higher atmosphere. So for that there's a cost. Environmental safety and health related assets can be acquired by the company, can be constructed by the company. Then what is the applicable standard? LK 16, property, plant and equipment. Are we clear with that? Are we okay with that? Right. Okay. Moving on. So giving a brief about the theory part. So, to make a provision in the financial statements, 3 conditions to be satisfied. What are 3 conditions? Number 1, there should be a present obligation as a result of a past event. So I have currently at the moment, I have a present obligation. That present obligation can be a legal obligation or a constructive obligation. We'll look at that in a little while. What is legal obligation and what is constructive obligation? Then outflow of economic benefits should be probable. Probable means what? More likely than not. More than 50% chance is there to happen this outflow, carry out this outflow. Then amount, rupee value can be estimated reliably. If these 3 conditions are satisfied, we need to recognize the provision and make certain disclosures in the financial statements. Always, when you are making the provision, look at whether all these 3 conditions are satisfied. In that case, you need to make a provision. And I told you these provisions, when you are making a provision, it's very important for you to understand what is the obligating event. What is the obligating event? So this obligating event can be a legal or a constructive obligation. What is legal? Legal means because of a contract that you have entered into, or else because of a law or legislation in the country, you have a present obligation. Now, in this case, it's more or less, if you look at the first situation, product liability, okay, product liability claims, litigations, right? All these things are what? Legal obligations. And even with regard to this waste disposal, there are environmental protection acts. If you have violated those, you can have the government can take legal actions against you. So you have a legal obligation, clear legal obligation. On the other hand, sometimes those are not legal obligations. There can be a constructive obligation, which means you behave, this is important to understand, you behave in such a manner as an organization which creates valid expectations in the minds of the other people that you would undertake certain responsibilities. What is it? You behave in such a manner, right? You behave in such a manner where you created what? Valid expectations in the minds of the others, you would undertake certain responsibilities. Good example what I can give you is, let's say you published environmental policies and you say you publish those in everywhere, your website, newspapers, magazines, right? You published policies. Then what happens is the people who are living in the surrounding environment create a valid expectation that you are an environmental friendly entity. Whatever the damage that you do to the environment, you will rectify, right? Then even though there is no legal obligation, you create the valid expectations of the minds of the others, you discharge certain responsibilities. So that is your obligating event. So the point what I have mentioned is this public policies, or else it can be a sufficiently specific current statement. Let's say at the opening of a factory, new factory, you have a press conference, you call upon everyone and say that you make a statement, your board of directors make a statement, we are an environmental friendly entity. Whatever the damage that we make to the environment, we rectify. Sufficiently specific. You make a specific statement, and that is done by a authorized person, board of directors, or the managing director of the company. He has mentioned that. It is sufficiently specific current statement, yet again it creates valid expectations in the mind of the other people. Or it can be sometimes your past patterns that you have followed. So some or the other, if you create a constructive obligation, you need to recognize a provision. Are we clear? Right. Then these are the thresholds that you need to be aware, right? So virtually certain, probable, possible, and remote. Normally we consider if you have a 95% equal or more, your probability is more than equal or more than 95%, equal or more than 95%, we say that it is virtually certain. Probable, so this is the only word actually that is defined in the standard, all others are industry practices. So the probable is defined in the standard as what? More likely than not. That means more than 50% chance, more than 50%, not 50%. 50% is possible, more than 50%. 50.001 is probable. Then possible means less than or equal to 50%, let's say 30%. Remote, less than or equal to 5%. So this is actually your judgment when you decide the accounting treatment. So these are the threshold that you need to keep in your mind, and based on that you need to make a professional judgment. Should I make a provision? Should I consider this as a contingent liability and make a disclosure? Is it a remote one? If it is remote, I can totally ignore about that. So you have to make your professional judgment. And with that, the link is there's a risk of material misstatement as well on the other side. If your judgment is incorrect, that can lead to a risk of material misstatement, right? Then that is about the provisions. Then contingent liabilities. A lot of people do not have correct understanding about this. Why do I say so? You should understand there are two types of contingent liabilities that you can have. You have two types of contingent liabilities, right? What is it? First one, look at the difference between the first and the second. This is what? Possible obligation, not a present obligation, arising from a past event to be confirmed by future event, not wholly within the control of the entity. Let me give you an example, then you can understand. Let's say one of your business partner came to a factory visit. You have two factories, no? He has come to a factory visit. Then he's so excited by looking at your factory. What he did was he was now your floor is also bit slippery, but you have so he has just come. Then he was so excited. He was running here and there, and ultimately he fell down and he got his knee injured. Right. Ultimately, what has happened is he went back and filed a case against you. Here, you have not maintained the premises in the proper condition. It was unsafe, and this is my hospitalized fee. So he was claiming that from you. He has filed a case. Now, what is this for you? Then when you consult the lawyers said that we are not in guilty. Yes, floor was just cleaned, but we put the name boards to say that, okay, it is slippery. He was not looking at those, and he was not working. He was running here and there, jumping up and down. So in that case, we are not in guilty. So no issue. That was the suggestion given by the lawyer. But still, you should understand that is a possible obligation, right? Because of a past event to be confirmed by a future event not within your control, because it ultimately it is a decision of the judge. So the court order that is not within your control. So that is the first type of contingent liabilities, right? Second one is present obligation. Normally, so second one is about the present obligations arising from a past event. That means same as the first condition of the provision, right? Present obligation as a result of a past event, right? Present obligation as a result of a past event. But to make a provision, first condition has to be satisfied, right? So I'll write it here. To make a provision, to say that something is a provision, first condition, second condition, third condition, all three should be satisfied, then it's a provision. Clear? Let's say first condition is satisfied, present obligation as a result of a past event. Economic benefits are, outflow of economic benefits are probable. It is probable, outflow of economic benefits, but you can't measure the amount reliably. You can't measure the amount reliably. Then can you recognize? Because provisions are recognized. No, then this would become what? Contingent liability. Did you get my point? Again, first condition is satisfied. Satisfaction of the first condition is a must. Then when you look at the outflow of economic benefits, now if I apply to this particular situation, second situation, example, let's say the same example. So the business partner has come. He was jumping here and there, running here and there, and he got his knee injured because as he fell down. Then when you consult the lawyers, look at the difference between this and this. Look at the difference. When you consult the lawyers, what lawyers said was, here we are in guilty. Our flow was slippery. That's true. But we can defend the case because we are the lawyers. We are there to help you, but we are sure that we can defend the case. Then when you ask lawyers, okay, what is the probability of losing this case? Lawyers said that, okay, you have 30% chance of losing the case, but 70% chance is there to win the case. What is this? We are on guilty, which means there's a present obligation, right? As a result of a past event. And it can be measured reliably as well. So we know the amount of the claim that is claimed by the other party. But outflow of economic benefits are not probable because lawyers said that what is the probability? 30%. 30%. It's possible, it's not probable. So now if I go back and put it here, first condition and the third condition is satisfied, but not the second condition. It is not probable. Yet again, it's a what? Contingent liability. Did you get my point? This is a very important analysis. Did you get my point? Did you understand? Did you understand this? Okay, great. Right, so when you have this question in the exam out of this area in the unseen, if you have a question, you need to carefully look at whether it's a provision or whether it's a contingent liability. Then contingent asset, just for the completeness, I don't think that there'll be a situation of a contingent asset, right? Contingent asset, unless otherwise, okay, there can be a situation, I'll tell you. So what is contingent asset, first of all? Contingent asset means opposite of the contingent liabilities. These are possible assets arise from a past event, to be confirmed by future event, which are beyond the entity's control. So it can be a situation, you file a case against someone. You are the one who filed the case, but you are not sure that you are going to get this claim. It is only a possible asset. You have only 30% chance of winning the case this time. Okay. So a possible asset because of a past event to be confirmed by a future event, court order, which is beyond your control. Right. Now, applying the contingent assets to this scenario, if I go back to the first particular situation, this particular situation, when you have a product liability claim, when you have what? Product liability claim, I told you that can lead to a situation of a provision, or that can lead to a situation of a contingent liability. Right? Let's say that will amount into a provision. There's a clear-cut obligation. We have done something wrong. Some of the ingredients that we utilized was harmful to the human health. We were so careless, so that I had to pay this claim to the customer. So you need to make a provision. Then what I did was, on the other hand, I have taken a product liability insurance. I have taken a what? Product liability insurance from an insurance company. Now, on one side, I have a provision, that is the claim. On the other hand, I have an asset. Then you have to look at that, okay, what is the probability of getting this asset? What is the probability of getting this claim from the insurance company? Is it virtually certain? Is it 100% sure? Then it's an asset. Then it's an asset. But sometimes you have to look at, okay, if you have clear negligence, gross negligence, insurance company might reject. Insurance company said that you have to maintain the standard in this manner, but you haven't done those. So then you are not sure whether you get this claim from the insurance company or not. So when you look at the situation, let's say it's not virtually certain, it's only probable, or it's only possible of getting the claim from the insurance company, then that will lead to a what? Contingent asset. Contingent asset. If it is virtually certain, it's an asset. But if it's not sure, it can be a contingent asset. Are we clear with that? Are we okay with that? So this is the summary. Let me skip this slide and go there. This is the summary of recognizing the liabilities and asset. So see and read the table by yourself and see that whether you can understand this and whether this concept of prudence is correctly applicable here. Just have a look and see. What do you say? Is it correctly applied or not? As I mentioned, if it's virtually certain, probability of the inflow in the case of the asset, probability of the outflow in the case of liability, right? If it's virtually certain, liability you provide, recognize, asset you recognize, right? Virtually certain means equal or more than 95%. If it is probable, a liability, what you do, you provide. But if it is probable in the case of an asset, are you going to recognize the asset? This is where the prudence come into play. A liability probable, recognize, provide. But asset probable, you just make a disclosure. Now the insurance claim from the insurance company, if it is probable, you can't recognize that. You have to recognize that only if it is virtually certain as an asset. If it is probable, you just make a disclosure. On the other hand, liability is possible. If it is possible, contingent liability, you make a disclosure. If an asset is possible, you even don't make the disclosure. So the insurance claim from the insurance company only possible. In that case, don't disclose that even. Liability is disclosed, assets no disclosure. If it is remote, 5% or less, in the case of liabilities, in the case of asset, even no disclosure is required. Important table to pay attention and understand. Now that is discussed in detail here. When it comes to contingent liabilities should not be recognized in the financial statements. That is just a disclosure. These are disclosure. Sorry. This is a disclosure only. Then it has to be disclosed in a note. It has to be disclosed in a note unless the possibility of transfer of the economic benefit is remote. Unless otherwise it is remote, it's a disclosure. When it comes to the asset, contingent assets should not be recognized. Assets are, if it is contingent, should not be recognized. But if the possibility of inflow of economic benefits are probable, then it has to be disclosed. Asset probable, disclosed, right? If the gain is virtually certain, if the insurance claim from the insurance company is virtually certain, then it falls within the definition of the asset. If it is an asset, it has to be recognized. It's not a contingent asset. If it is virtually certain, recognize the asset. All clear now? Is that clear with you? 100% understood? Guys, are you clear? Got it? Okay. Then dig into detail. Actually, I discussed these points, right? So when it comes to provision, there are different types of provisions. Okay, we discussed there are different types of provisions. So with regard to this scenario, one of the provision I explained product liability. Okay, another type of a provision with regard to the environmental matters, you have recognized an environmental provision. So yet again, the same condition to make a provision, three conditions to be satisfied. Okay, present obligation as a result of a past event. This particular present obligation can be a legal obligation. It can be a constructive obligation. Legal means because of the law or a court order or because of a contract. Constructive obligation means you create a valid expectation in the minds of the people. You would undertake certain responsibility. Somehow or the other, there should be a legal or constructive obligation for the to repair the environmental damage that you have done. Right? But you should understand, this is another important point, merely causing a damage or having an intention to clean up doesn't make a provision. So the standard clearly mentioned you can't make provision as per your wish. Now, for an example, let's say you carry out your operations because you have agricultural operations, you have factory operations. This particular company, CAPL. So by carrying out these agricultural operations, factory operations, you make a damage to the environment, right? You make a damage. Making a damage is not enough to make a provision. Three conditions has to be satisfied because you should have a present obligation. Making a damage does not always create obligations. Similarly, let's say you make a damage and you have an intention to clean this particular site. But again, intention is also not enough, right? You are a good entity, you don't have a legal obligation, you don't have a constructive obligation, but your board of directors has decided we are going to do this, we are going to clean up this site. Is that enough to make a provision? No. So because examiner can be tricky sometimes, he might give you a scenario where there's a damage, right? So damage has happened, company's board of directors are intending, but it has not been communicated to the outside parties, and outside parties are not expecting company to carry out this activity, but company is going to do that. So can we make a provision? No. Intention is not enough. You should have a present obligation. Are we clear with that? So then the third point I explained to you how a constructive obligation can be created. Constructive obligation can be created because of the what? Published policies, or else sufficiently specific current statements made by the company that create valid expectation in the minds of the other people that would lead to recognize provisions in the financial statements. Okay, so entity may have a constructive obligation to repair the environmental damage. This will be the case, for example, entity published policies that include environmental awareness or explicitly undertake to clean up the damage caused by the operation. That means sufficiently specific current statement. So this is the point what I have mentioned. There must have been a what? Past obligating event, either a legal obligation or a constructive obligation. And the next point is you can make provisions only for the environmental damage that it has already happened. Again, another important point. What some people are trying to do is they are trying to make provisions for the future damage that can cause to the environment. Can you do that? No. Why? You don't have a present obligation. If you stop the operation today, there won't be a future damage. So whatever the provision that you make, only relevant with the damage already done, and also there should be a legal or constructive obligation to carry out that particular damage rectification work. So that's how LKS 37 is going to be applied into the particular scenario in this question. But I told you, so not only LKS 37, there are other standards. There are what? Other standards which can be applicable for this scenario. What is the next one? As I mentioned, any questions with regard to LKS 37, guys? Any questions with regard to LKS 37? No issues. Great. Right. The next one is what? LKS 10, events after the reporting period. What can happen is, so now at the year end, there can be pending litigation, right? Then the decision of these litigations can be given after the year end, but before the financial statements are authorized for issue, right? So what is the period which is covered by LKS 10? From the reporting date to the date where the financial statements are authorized by the management, board of directors. So if there are any events, favorable or unfavorable events have occurred during this period, you need to look at whether it is an adjusting event or non-adjusting event. Adjusting event means what? Adjusting events provides confirmation or additional evidences about the condition existed at the reporting date, right? That means if the pending litigation was there, might have been at the year end, you disclose this as a contingent liability. You have not recognized the provision because you believe that that is only a possible obligation. But the decision was given subsequently before the financial statements are authorized to issue, where you are in guilty. You need to make a payment to the other party. Then what you have to do? You have to go back and show this amount as a provision at the year end, because that is a what? Adjusting event. Sometimes the provision what you made is not enough. Okay, at the year end you made a provision, but the court order was given to pay a higher amount than that. Then yet again it's a what? Adjusting event, because condition was existed. It provides further evidence on the conditions existed at the reporting date. Go back and adjust your financial statements, right? But certain events are totally new events. Okay, no new event. Let's say during this particular period, customer, one of the customer made a complaint. Okay, made a complaint that was not there at the year end, but after the year end. It's a new case, and company was not aware about this risk at the year end. These are totally a new event. If it is totally a new event, you are not going to adjust your financial statements at the year end. What you do is, if the particular event is material, important, you make a disclosure about the event. Is that understood by you? Good example would be, not relating to this question. Let's say there was a fire after the year end, but before the financial statements are authorized for issue. Now you are not aware about this fire at the year end, new event, right? Condition was not existed. So if the event is material, impact is material, you need to make a disclosure, right? Remember, LKS 10 covered only up to the date of financial statements are authorized for issue. Then after that, after the financial statements are authorized for issue, information made public. Let's say you what you call you have given your numbers account or the financial statements to the public. Maybe you can publish in a newspaper, you can publish in the stock exchange website. So you made information public, and after that the shareholders meeting will be held. So what I'm telling is, after the date where the financial statements are authorized for issue, if there are any events occurred, those are not covered by LKS 10. LKS 10 covered from the reporting date to the date where the financial statements are authorized for issue. As I mentioned, adjusting event means what? Provide evidence on the condition existed at the reporting period. You have to adjust the financial statements. You have to pass double entries and show the impact at the year-end financials. Non-adjusting means these are the conditions that arose after the reporting period. You make a disclosure only if the event is material. So that's how LKS 10 is going to be applied in this situation. So if examiner tests LKS 37, he can easily test some areas of LKS 10 as well, events after the reporting period, because these two standards have been tested together in most of the times in the past. If it is 37, there's an involvement of LKS 10 as well, right? Then I told you, if I go back to our initial discussion, I told you here, so under all these matters, so there's an implication of LKS 37, provisions, contingent liabilities, and the contingent asset standard. Then, sorry, this has to be not 12. I'll correct it, not 12, it has to be 10. LKS 12 is income taxes, right? Not 12, sorry for that. LKS 10 events after the reporting period. Thereafter, LK 16 and going concern. I told you how LK 16 can be applicable here is, now because government said that within 6 months you need to rectify, otherwise we'll take your license to operate. Now you have to have a solid or proper waste disposal procedure. Due to that, what can happen is company may invest in certain environmental, health and safety equipment. Now, when you invest in this equipment, the question is, can we recognize this investment in this equipment as a PP&E? What do you say? Can we, because here there's no, now when you do this activity, when you invest in this environmental safety equipment, so these equipment will not generate me direct economic benefits. Just because I invested, I don't get the additional cash flow. So because of that, my question to you is, can you recognize this equipment as assets, PP&E? Because we know that to recognize a PP&E as an asset on the balance sheet, two conditions to be met. Economic benefits are probable. That means you should get additional economic benefits, cash, and cost, amount, value, or the cost can be measured reliably. So these are the recognition criteria of PP&E. So think this particular example. Now you have you didn't have a proper waste disposal procedure with regard to the toxic air. So for that, what you did was you put up chimneys to release this toxic air to the higher atmosphere, not to the surrounding environment. It can be a different example. You didn't have a proper drainage system. You wanted to put up a proper drainage system. Now, without dumping the stuff into the nearby river, you follow a proper waste disposal procedure. So you invest. Can you capitalize that cost as PP&E? The question is, can we say that the first condition, future economic benefits are probable from this investment? What you need to understand is, this is a very important point. Even though these assets or this equipment, health and safety equipment, environmental equipment, doesn't generate economic benefits directly by its own, these investment or these equipment, right, enables us to generate or obtain economic benefits from the related assets in excess of those benefits it could otherwise be earned. Because I have chimneys, I can run the factory without having any interruption, without having any protest. If you have any interruptions, I can't carry out the factory 24 hours. Now, as I have this investment chimneys, I can get the economic benefits from the related assets in excess that could otherwise be earned. So the point is, even though there's no direct economic benefits, there are indirect economic benefits because related assets can be used more effectively. So on that ground, the amount what you spend on the environmental health and safety equipment, you can capitalize as a property, plant and equipment. Are we clear with that? Did you get my point? Did you get my point? Right, got it. Then going concern. What is going concern? So when preparing the financial statements, and organizations believe that so this particular entity would continue for a foreseeable future. So management doesn't have any intention to liquidate or the cease operation of this entity. So it is very important assumption at the year end you need to make. So based on that assumption only, you can segregate your assets into current and non-current. Short term, that means 12 months or less, current, long term, non-current. If it is not going concern, you can't segregate, right, into current because there's no long term in that case. So even the liabilities you classify current and non-current. So when you're assessing the going concern, at least you need to look at next 12 months period, whether the entity is going to be exist. Now, in this case, there's an issue with regard to license. So the government clearly mentioned that if you don't rectify, we are going to revoke the license. But I don't think that organization would not take any actions because these are good organization. They want to run the operation. They would definitely take actions to mitigate that risk. But never know, right? What sort of information that the examiner would give you in the unseen. So when you're preparing the financial statements at the year end, if you have material uncertainties, which make a significant doubt about the going concern of the organization, those has to be disclosed. So there can be two things, right? There can be three things actually. At the year end, you assess whether the organization is going concern or not. Best possible scenario is, yes, it is going concern, no issue. You prepare your financial statements accordingly. Second situation can be, there are material uncertainties. There are significant doubts in the minds of the organization. But with these doubts, I'm not going to conclude that there's no going concern. Still, there's a going concern, but there are significant or material uncertainties exist. Okay, so it can be a legal issue, it can be a cash flow issue, right? So it can be because of the significant liabilities that the organization has. So if you have such a situation, you need to disclose that. But still you prepare the financial statements by using the going concern basis. But if there are material uncertainties, those uncertainties and the remedial action has to be disclosed. Finally, third scenario is the worst one. If you believe that entity is not having the going concern, no going concern, then you should not prepare the financial statements by using the going concern basis. You have to follow the breakup basis. So which means you can't classify your assets into current, non-current. Everything is current. Liabilities, no current, non-current, everything is current because it won't exist for a foreseeable future. No long term. And even the measurement basis of the asset values are different because you have to measure the assets at realizable value. So there can be significant write-offs in the asset values if you don't prepare the financial statements on going concern basis. Right? Okay, those are things that need to be looked at here. Right. So what we can do is we'll take a break. We'll take I would say 10 minutes break. We'll take a 10 minutes break. So thereafter, we'll continue with the rest of the areas of this handout. And I just want to mention, so today we'll be having the first session. Then the second session, especially the consolidation related stuff, group structure related stuff will be discussed on Sunday, right? So that would be the second session at 9 o'clock. So today we are finishing this particular tutorial, and so we'll have the second session in-depth analysis. You see, when I'm discussing, I'm not going to touch the stuff in surface. So go into detail, dig into detail and discuss. So that's why it takes time. That's why it's important, right? So for you to get to the examination, right? So let's take 10 minutes break. After 10 minutes, we'll continue with the discussion. Okay, so hope you're back. So let's continue the discussion. Okay, so here one of the information given in the pre-scene is, so the now CAPL is planning to issue additional shares in future to the institutional investor Blue Rock. So, and the funds generated out of this share issue are expected to be used to increase the production capacity in order to meet the demand of the overseas expansion, right? So companies having overseas market, they are actually they are trying to focus more on the overseas operation by expanding the operation. Now with the like overseas operation, because now examiner is having the current tendency of actually putting the current scenarios also into the exam paper. Now all of us know that at this moment we have a crisis and companies are really worried about dollar earnings, so that they want to expand the overseas operation. With that intention, they might aggressively focus on exports, right? And it can even go up to a level with the consolidation areas we'll discuss in detail. So these funds can be utilized to start up a overseas operation. It can be a foreign subsidiary. It can be a joint venture in the foreign country. So even that can be tested. Now here, I'm not going to take up the consolidation part. So discussing about the uh, impact of the exchange rate when it comes to the individual transactions. So applicable standards are what? LKS 21, effects of the foreign exchange rates, and also SLFRS 9, because when you deal in foreign currency, when you have foreign currency receipts and the payment, obviously there's a risk of exchange rate, especially in a situation where the exchange rate is highly volatile. So to reduce that risk or to minimize that risk, company can enter into derivative products. So these derivatives are to be accounted under SLFRS 9 financial instrument standards. And even, you know, examiner can give you a scenario using these derivatives with the intention of hedge accounting. Okay, so that is what I'm going to discuss at this moment with regard to this particular information. So first of all, looking at the application of LKS 21, effects of the foreign exchange rates, we know that so in Sri Lanka, so the functional currency of this particular company, CAPL, is rupees. So any other currency dealings are considered as foreign currency transactions. So obviously when the company is engaging in import and export activities, in this case, export activity, so before recording the foreign currency amount, let's say dollar amount, you have to convert that into rupees. When you are doing the conversion, you have to use the exchange rate at the rate of the transaction. Now, for an example, let's say you make an export today, and so at the time of booking the revenue and the debtor balance, it's a credit sale. You have to use the exchange rate prevail today. Let's say credit period is 2 months. After 2 months time, when the customer is making the payment, exchange rate today and the exchange rate in 2 months time can be different. So what you do is at the time of cash receipt, you have to use the exchange rate prevailed at that time. Initially, when you are recognizing the data on the balance sheet, you use the different exchange rate because you have to use the exchange rate at the rate of the transaction. So due to the differences in the exchange rate, you will have a foreign exchange gain or loss. So this is actually, if you receive cash from the customer, then it would become a realized exchange gain or loss because the transaction has been settled. You made the sale under 2 months credit, and after 2 months you received cash. So the both transactions are counted at the spot rate on the date of the transaction. So the two exchange rates are different, but the transaction has been settled. So there will be exchange gain or loss. That is a realized exchange gain or loss that is recognized in the profit and loss statement. So the realized exchange gains and the losses are recognized in the profit or loss statement, right? And the other point is all the foreign currency transactions are to be recorded by using the rate of exchange at the rate of the transaction. But sometimes people use average rates rather than using the spot rates, because the standard says what standard says is to use the spot rate. for each and every transaction, but you can use an average rate for a week or average rate for a month as an approximation, provided there are no significant fluctuations in the exchange rate. If the exchange rate is more or less stable, no significant deviations, you can use the average rate, but you can't use the average rate when there are material deviations or the changes in the exchange rate. There you need to go for the spot rates. I hope you understood. Then the next point is, let's assume you have entered into a foreign currency transaction. That particular transaction has not been settled by the year end. Now, take an example. Let's say you have done a credit sale to an export customer, and that customer has not yet settled by the year end. So, which means you have booked your revenue and you have booked your receivable trade data at the date of the transaction, on the date of the initial transaction. Let's say my year end is 31st March. You have done this transaction somewhere in 10th of March. So based on the spot rate on 10th of March, you recognize the revenue, you recognize the receivable. Now 31st of March, this particular data balance is not settled because the credit period is 2 months. What you need to do? Now you have a foreign currency data on your balance sheet. So that foreign currency data is going to be settled in dollars, right? Not the functional currency of your entity, because your entity's functional currency is rupees. What you need to do? Are you going to revalue, or are you going to value this particular foreign currency asset by using the closing exchange rate, 31st March exchange rate, or are you going to keep that at historical rate? What do you think? What do you think? It depends on the item that we are talking about. Now, in this case, it is a customer data receivable, trade receivable. That is a what? What type of an asset? Monetary asset. So whether if the particular foreign currency asset or the liability is a monetary item, monetary asset or a liability, what you need to do is you need to measure by using the exchange rate prevailed at the reporting date, year-end rate, right? So examples for the monetary items: receivable, cash, payable, right? Even the foreign currency loans are monetary. Monetary means you know exactly the amount of or number of units of currency in case of a liability that you need to settle, in case of an asset that you are going to realize. Let's say, for an example, when you have a debtor customer, you know exactly this is the number of dollars that I'm going to get. Exactly number of units of currency you know that you're going to get. Let's say if you have a bank loan, foreign currency bank loan, you know exactly this is the number of dollars that I need to pay. Those are monetary. Non-monetary means things like PP&E, intangible assets. So those items you don't know exactly. Let's say you have a property in a foreign currency, in a foreign country. You have a PP&E item in a foreign country. Do you know exactly the number of units of currency that you get out of this? Exactly this number of dollars that I'm going to get out of this? You don't know. Then it's what? Non-monetary, right? So intangible assets, then PP&E, inventory are considered as non-monetary items. So if the items are non-monetary, you are not going to measure them by using the year-end rate. Those are kept at the date of the transaction, which means historical rate. Okay. If the particular item that you have denominated in foreign currency is a monetary asset or liability, you measure that at closing rate, you recognize the exchange gain or loss. This is unrealized exchange gain or loss. That unrealized exchange gain or loss you take to the profit and loss statement with regard to the monetary items. But if you have non-monetary items, where these non-monetary items are measured at cost, things like PP&E, intangible assets. So those items are not getting converted by using the closing rate. You keep that at the historical rate. That means there are no exchange gains and losses, right? There are no exchange gains and losses. But let's say you have non-monetary items. Those non-monetary items are revalued. Good example would be you have a PP&E item, building. Okay, so that building is denominated in foreign currency and you follow the revaluation model to account for that building. In that case, even though the item is non-monetary, as you follow the revaluation model, what you need to do is you have to use the exchange rate at the date of the last revaluation. exchange rate at the date of the what? Last revaluation. Okay, if you have done the revaluation at the year end, then year end rate. If you have done the revaluation 1 year ago, the rate what it was prevailed 1 year ago has to be used. Are we clear with that? Are we okay with that? So what I'm telling is, so now if you get any unrealized, so all these scenarios, now when you measure something at the year end and convert by using a different exchange rate, when you have gains and the losses, those gains and the losses are considered as unrealized, right? Unrealized gains and the losses. Okay, now when you have an unrealized gain or loss from converting a monetary item, that unrealized gain or loss is taken to the profit and loss. But if you have an unrealized gain or loss in this situation, let's say because of the revaluation of a property, so there the exchange gain or loss, unrealized exchange gain or loss, you are not going to take to the P&L, there you take to the other comprehensive income. Through that it goes to the equity. But if you have realized exchange gains and the losses, what is realized? Transaction has been happened during the year, it has been already settled. So there's no year-end asset or a liability. So realized exchange gains and the losses are always taken to the profit and loss statement. So that is the basic principle that you need to understand with regard to LKS 21, accounting for individual foreign currency transactions. Okay, right. Any questions? Okay. So how to differentiate monetary and non-monetary? That's why I mentioned that. What you need to understand is monetary means you know fixed or determinable number of units of currency that you get in case of an asset. In case of a liability, you know exactly this is the number of units of currency that you need to pay. When you have cash, receivable, payable, bank loan, you know exactly this is the number of dollars, this is the number of rupees. But things like PP&E, intangible asset, every asset has a book value. I'm not talking about the book value. What I'm telling is when you have a PP&E, intangible asset, do you know exactly this is the number of dollars that I'm going to get out of this PP&E? You don't know. Those are what? Non-monetary. Okay, so that's the classification between monetary and non-monetary. Right, okay. Then examiner can come with a innovative question where now there's a risk, foreign currency risk, because exchange rates are fluctuating. That would affect your cash flows. So to minimize that impact, examiner can give you a scenario where companies are entering into a derivative. Maybe under the current scenario, we can't enter into forward currency contracts in the country, but let's say it can be a forward. It can be any other derivative. So in Sri Lanka, what we have mainly is the forward, but in addition to that, you have things like futures, right? So you enter into a derivative to minimize this risk. Then you should be aware about what is the accounting treatment for the derivatives. How are you going to account for the derivatives? When it comes to a derivative, we know there are three characteristics. So derivative has three characteristics. Number one, value of the derivative is depending on the underlying. For an example, let's say you enter into a forward currency contract, right? You enter into a forward currency contract. Then when you enter into a forward currency contract, right? What is the value of this contract? What is the value of this derivative is depending on the what? Movement in the exchange rate. Movement in the exchange rate. Now, value of the forward, whether it is an asset, whether it is a liability, is depending on the movement in the exchange rate. So the point what I want to mention is fair value of the derivative is always depending on the changes in the underlying. Underlying can be different to each variable or each derivative. Now, if it is a currency, forward currency contract, underlying variable would be the exchange rate. Right? Depending on the exchange rate, it can be a favorable scenario, it can be an unfavorable scenario of entering into the derivative. It can be a derivative asset or it can be a derivative liability accordingly. And the value of the derivative is also getting changed once the exchange rate changes. So the value or the fair value changes of the derivative is in response to a particular underlying variable. So the underlying variable can be exchange rate in my example. But you have other derivatives like, interest rate swaps. In the case of interest rate swaps or the interest rate forward contracts, or interest rate guarantees, there are different types of derivatives. You can have different underlines. So they are the underlying variable would be the interest rate. Right? Then if you have options, share options, you may heard about the share options, right? Share options, right to buy shares in a future date at a pre-agreed price, pre-agreed exercise price. So when you have share options, value of the share option is depending on the share price, security price. Similarly, when you have commodity options, value of the commodity option is depending on the commodity prices. You don't need to know all these things, right? So the point what you need to understand is you need to understand when a particular contract is entered, this is a derivative. So that's why I'm explaining you three conditions. So the number one is the value of the derivative is depending on an underlying. Number two, initial investment is zero or very little investment. Now, let's say if you want to enter into a forward currency contract, the value of the contract may be huge, $1 million, $1 million, but the initial cost would be zero or very little, right? And the third one is, so the derivative is going to be settled on a future date. Let's say forward currency contract is entered into 2 months. For a 2 months period, you enter into a forward currency contract because your credit period given to the customer is 2 months. So you enter into a forward currency contract for 2 months. So that currency contract is going to be settled on a future date, right? So these are the three characteristics of derivatives. And if you look at the accounting of the derivatives, so what is the accounting? Can anybody tell me? How do you initially measure derivatives? How do you subsequently measure derivatives? Hurry up, hurry up. What is the initial and subsequent measurement of derivatives? Easy stuff. On initial recognition, derivatives should be measured at fair value because it's a financial instrument. All the financial instruments are measured at fair value at the initial recognition under SLFRS 9. Right? Then what is the subsequent measurement of derivatives? Fair value through profit and loss. Always derivatives are measured under the FVTPL category. FVTPL category, fair value through profit and loss category, which means at the end of each reporting date, you fair value the derivatives and value changes are taken to the profit and loss. Even though the value changes are unrealized, that is taken to the profit and loss, right? Then, if something is categorized under FVTPL category, this is common for all financial assets and all financial liabilities. If something is classified under FVTPL category, and if you measure the financial asset or liability under value through profit and loss, subsequently, the transaction cost that you incur on such instruments, you charge to the profit and loss statement. If you incur any transaction cost when acquiring the derivatives, as it is subsequently measured under FVTPL category, you charge to the P&L. If the financial asset or liability is measured under any of the other categories, if it is an asset, it can be value through OCI or it can be at amortized cost. In that case, what do you do with the transaction cost? You don't charge that to the P&L, you add to the value of the particular financial asset. You add to the value of the particular financial asset. Right? Similarly, financial liabilities, if you measure it at FVTPL, transaction cost is expense to the P&L. But if you measure that under amortized cost, transaction cost is not expense to the P&L, you deduct the transaction cost from the particular financial liability. Okay, so those are the basics that you need to be aware. Just I told the point for you to be vigilant on that if that is tested. Right. Okay, so the point is company is expanding into the foreign operation. With these expansions, there can be many number of foreign currency transactions, right? So it can be day-to-day transactions like exporting and importing, and even it can go up to a level where company is taking a foreign currency loan because company would have a lot of export revenue, dollar income. Now, when company has dollar income, what company can do is take a foreign currency loan. Then by using this dollar income, you can settle the loan because the interest rate of the dollar loans are low comparatively with the rupee loans. So the rupee loan cost is very high. So you can take a dollar loan, but everybody is not eligible to take the dollar loans. So you have to prove that you have enough export income to settle this loan. So those type of transactions can occur in terms of the foreign currency. So the applicable standard is first of all LKS 21, effects of the foreign exchange rates, and thereafter company can use the derivative products to manage the foreign currency risk exposure. If so, how to identify this is a derivative and how to do the initial and the subsequent accounting for the derivatives are discussed by now. Are we clear? Right. Then examiner can even go up to what? Hedge accounting. Not tested for a while, right? Hedge accounting. What is hedge accounting? Hedge is all about offsetting. Hedge is not to make profits. Hedge is not to make money. That is to offset the risk. In hedge accounting, you need to identify what is the hedge item and what is the hedge instrument. Hedge item creates the risk. Hedge instrument offset the risk. Hedge instrument is normally a derivative. Okay, so when you use the derivatives into transaction, when it comes to financial reporting, you have two ways of doing it, accounting it. One is company can use the hedge accounting if you can prove that hedge accounting criteria is satisfied. There are 3 criteria to satisfy before you use the hedge accounting. Or else company can opt not to apply the hedge accounting. Even though you have used the derivatives for hedging, it's not a mandatory requirement for you to apply the hedge accounting. Company can say that, okay, I'm not going to apply the hedge accounting. I just account this as a derivative. So I'm not going to go into detail about, hedge accounting requirements because it's a detailed discussion. So that's why even not only in the theory package, but also in the what you call revision package, I have included fully about the financial instrument accounting. So the recorded video sessions covered almost 15 hours. So these concepts are discussed in very detail, right? So what you can do is you can watch these videos to understand the full picture. But at this moment, I'm just, explaining you the possible areas that can be tested in the examination, right? Coming back to the hedge accounting. So in hedge accounting, as I mentioned, so the hedge item creates a risk. Hedge item creates a risk. What type of a risk? It can be a fair value risk. So the fair value of the asset or the liability is getting changed. So that has an impact on company's profitability. Or else it can be a cash flow hedge. Cash flows of the entities is getting volatile. You can't predict the cash flows. It is volatile. Then that creates a cash flow risk, and ultimately again it affects the profit and loss. So to minimize this risk, what company does is company enter into a hedge instrument. Company use a hedge instrument. So the hedge instrument can normally be a derivative. So if I take this example, so company is having a foreign exchange risk. Company's future cash flows are volatile. That would affect the profit. So to minimize or to offset the risk, what company has done was company has entered into a forward exchange contract, forward currency contract. Now this forward currency contract is the derivative and it is the hedge instrument. It is the hedge instrument. So yet again, when we were discussing the theory, we discussed there are 3 hedge items. What are 3 hedge items? Can anybody tell me? This is how you can measure by yourself whether you have studied enough or not. These are very basic questions. Huh? These are very basic questions. So what are the 3 items or what are the 3 hedge items that we can have? Not only in this question, but what I'm telling is overall, very simple, straightforward question. What are the 3 hedge items that we can have? Hurry up quickly. No. Some people are saying these are hedge accounting models. You are talking about hedge accounting models. What I'm asking is so hedge items can be in 3 ways. What are these? Number 1, it can be a recognized asset or a liability, right? It can be a recognized asset or a liability on the balance sheet. Or it can be a firm commitment. Number 3, highly probable forecasted transaction. So these are the 3 hedge items: recognized asset or liability, firm commitment, and highly probable forecasted transaction, right? So then you have 3 hedge accounting models. Out of these 3 hedge accounting model, what is applicable for your exam is only 2: fair value hedge accounting model and the cash flow hedge accounting model. Actually, if it is this particular example, so the entering into a forward contract to manage the risk of the future cash flows, I would say that what is the hedge item out of the three what I have mentioned? It is a highly probable forecasted transaction, and the hedge accounting model that you need to use is cash flow hedge accounting model. Okay, right. Anyway, so it seems that some of you are not having a thorough understanding. Please ensure that you watch the videos related to the financial instrument. So there's nothing to skip there. So regular tested in the examination, you can't find a paper without a question of financial instruments. Simple as that. Okay, right. Okay, so as I mentioned, these are the hedge accounting models: fair value hedge accounting model, cash flow hedge accounting model, and hedge of a net investment in a foreign operation. So the third one is not going to be tested in questions in the exam. That is a scenario where can be applied to this question actually. What is it? You start a, let's say now CAPL, our company is planning to issue shares to Blue Rock institutional investor in the next year, or in the future next year, let's assume 22, 23. So CAPL receive cash. Out of this cash, what CAPL can do? CAPL can start a foreign subsidiary, or else they can enter into a foreign JV. Now, part of this investment can be funded by a foreign currency loan to minimize the risk. It's a hedge. You make a foreign currency investment to minimize the risk of, or to minimize the uncertainty of change in the exchange rate. What you do is you hedge that investment with a foreign currency loan. So that is the third scenario, hedge of a net investment in a foreign operation. But it's not going to be tested in terms of the numbers. So in the terms of numbers, what it can be tested would be fair value hedge accounting model or the cash flow hedge accounting model. More specifically in this question, I would say, I would believe that what's going to be tested, if it is tested, the cash flow hedge accounting model. I'm not going to discuss in detail how to do the accounting for the cash flow hedges. In summary, very brief. Again, if you don't understand what I say, that means what? You have a homework to do. Go and refer this section. Okay, go and refer this section in the what you call it is there in the revision LMS as well as theory LMS. In both cases, I have uploaded the videos. Right. Cash flow hedge accounting model. What you do? In summary, in very brief, those who can remember, in cash flow hedge accounting model, you measure the hedge instrument. That means you have a derivative, let's say in this case forward currency contract. You fair value that derivative at the end of each reporting period. Up until the forecasted transaction occurs, you fair value the derivative, you fair value the hedge instrument. And the fair value changes of the hedge instrument, where do we take? To the other comprehensive income. This is an exception, right? Because why? Now understand. Earlier I told you what is the subsequent measurement of the derivatives. Hurry up, quickly answer, at least for the things what I discussed today, right? Earlier I told you, discussed with you, the subsequent measurement of derivatives, isn't it? What did I tell? Derivatives are subsequently measured at fair value through profit and loss, which means at the year end, you fair value the derivatives and the fair value changes are taken to the profit and loss. But this is an exception. If the derivative would become a hedge instrument of a cash flow hedge, you fair value the derivatives and fair value changes are taken to where? Not to the profit and loss, but to the other comprehensive income. Did you get my point? You fair value it and the fair value changes are taken to the other comprehensive income. Right? Then by saying that, if the gain or loss of the hedge instrument, that is the derivative, fair value gain or loss of the hedge instrument is more than the fair value gain or loss of the hedge item. For an example, I'll take a number. Let's assume fair value gain of the hedge instrument is $10,000. Value gain is 10,000. Then fair value loss of the hedge item is $9,000. If I take a number, fair value gain of hedge instrument. Let's assume I'm taking a number. I'll take the figure in rupees. Let's say that is 10,000 rupees. 10,000 rupees. Then fair value loss of hedge item, let's assume 9,000 rupees, that is what it has to happen, right? Because hedging is offsetting. If the hedge item creates a loss, hedge instrument should create a gain. Now what has happened? The gain created by the hedge instrument is more than the loss created by the hedge item. In this situation, what you do is, now no, earlier I said that if you have a fair value gain of the hedge instrument, where do I take the fair value gain? To the other comprehensive income. That's what I told. By saying that, if the fair value gain or loss of the hedge instrument is higher than the fair value gain or loss of the hedge item, excess amount, in this case, what is the excess amount? 1,000 you directly take to the P&L. So if this is the scenario, what you need to do is, out of the total fair value gain of the hedge instrument, 9,000 you take to the other comprehensive income, excess amount or the amount higher than the gain or loss of the hedge item, 1,000 you take to the P&L. Okay, that is the measurement rule. Thereafter, now this 9,000 you initially take to the other comprehensive income. Thereafter, it is getting accumulated in a equity reserve. This will go into a equity reserve called cash flow hedge reserve. So this value in the equity reserve will be, let's assume the total amount is also 9,000. This 9,000 on a future date will be reclassified to the P&L as a reclassification adjustment. If you can remember, so within the other comprehensive income, when you are preparing the financial statements, LK is 1, within other comprehensive income, you have 6 items. Out of these 6 items, 3 items are items which will not be reclassified to the profit and loss, and 3 items are items which may be reclassified to the profit and loss. Actually, this is an item which may be reclassified to the profit and loss in a future date. So the accumulated value in the cash flow hedge reserve may be or will be reclassified to the profit and loss once the forecasted transaction occurs. Now, here the forecasted transaction would be, you are making a sale and you receive cash. So once you receive cash, once the particular forecasted transaction occurs, what you need to do is accumulated value in this equity reserve, you need to reclassify to the profit and loss, right? So that is what I can explain at the moment, right? So I'm not going to discuss in detail, as I mentioned, because if I'm going to discuss in detail, I have to take a question here to explain the full scenario, but doesn't matter. Now you can understand, okay, whether you have the correct knowledge or not. If not, what you do is you need to definitely go back to your tudes, working material, study materials, and study. So and also you have the videos available, so you can watch these videos, right? So don't miss this area, right? Okay, so that's about the financial instrument derivatives hedge accounting, right? Okay, any questions? Any questions? Any questions? Yeah, no. Okay, so there's a question with regard to the revaluation. I'll discuss, so because there's a particular section, right? So at that time, I'll discuss that particular question. Okay, then moving on. So the next available information in the pre-scene is with regard to the categories of products which are sold by this company, CAPL. So they have 5 categories of products. Healthcare. So under that you have different product categories: toothpaste, hair oil, health supplements. Then pharmaceuticals, pain relief, Ayurvedic medicine. So here it was mentioned in the pre-scene, the growth was in the last year, 21-22, was 15%. Then herbal beauty products. So that is actually face cleaners, facial cleansers, sorry. Then toners, skin moistures, and body wash. Essential oil, nutmeg and clove oil. So where the growth in the last year 21-22 was 25%, and also it's mentioned that high demand from overseas. So if the question is about an overseas expansion, so I believe that so they would grow into this category. Okay, oils. Okay, they can have a factory, they can have a subsidiary, or they can enter into a JV, or it can be just an export activity targeting this area. Okay, and also beverages, so where they have tea. Then the contribution of each product category is also given below. So healthcare 25%, pharmaceuticals 15%, herbal beauty products 20%, essential oils 35%, and beverages 5%. Okay. So for what this information is important, useful, in case if we are doing the segmental reporting under operating segments SLFRS 8, because in addition to that, it clearly mentioned that company seek to get the listing of the Dirisai board next year, because uh, when you are a private company at the moment, this is not a listed company. So if it's not a listed company, it's not a mandatory requirement for you to follow SLFRS 8. It's only on voluntary basis. At the moment, let's say company might decide not to make the segmental disclosures, because it is voluntary, not mandatory. If company wants, company can do it. If company do it, company has to comply with 100% of the requirement of the standard, but it's not mandatory at the moment. But after getting the listing in the Dirisavi board in the stock exchange, there you can't get away with this disclosure. It's a must for you to do the segmental disclosures. So because of that, again, I'm not going to discuss all the steps one by one in the segmental reporting. You should know how to do the segmental reporting. So basically, this is I have included the summary with regard to the segmental reporting. You have to follow 5 steps, okay, in segmental reporting. Number 1, you have to identify who is the CODM, Chief Operating Decision Maker of your organization, right? He makes 2 important decisions. Number 1, resource allocation decision. So each segment, how much of resource that I'm going to allocate. And he is the one who is measuring or evaluating the performance of each of these segment. So anybody who actually carries out, it can be a person, it can be a committee. So anyone or a body of people who carry out these 2 activities, resource allocation and the performance assessment of the segments, is considered to be the CODM. You have to identify who is the CODM, because reporting organization can have only one CODM. Thereafter, you have to identify operating segments. I think that is already done here. Okay, these might have been the operating segments, right? So again, to say that a particular segment is operating segment, there should be 3 conditions to be met. I'm not going to discuss in detail, right? So what these 3 conditions are, if you can't remember these 3 conditions, you have to go and refer the standard, right? Let's say I identify these are my operating segments. Then thereafter, step number 3 says you need to aggregate the operating segments. So because if you believe that you don't need to show these 5 separately, you may aggregate, let's assume, beverages with something else, right? Aggregate. After aggregating, right, let's say you identify CODM, identify the operating segments, then you decide to aggregate uh, some operating segments, but yet again, you can't just do the aggregations. There are aggregation rules, right? So there should be similarities in the segments that you aggregate. Okay, there are conditions to be looked at. Okay, risk of these segments should be similar. Economic characteristics of these segments should be similar. There are 5 criteria given. So if these 5 criteria are similar, then only you can do the aggregation. Right? Then after doing the aggregation, determine the reportable segments. This is actually quantitative thresholds. You look at what are the segments which are material. So these threshold tests are conducted in terms of revenue, in terms of assets, and in terms of profit and loss, right? So there are computations done to identify what are the reportable segments. And also there's a test called consolidation revenue test under step number 4. You should know how to do the computations under the threshold test, right? And finally, what you do is this particular standard SLFRS 8 is purely a disclosure related standard, necessary disclosures as per the standard to be made. So the disclosures includes disclosures about the revenue, disclosures about the profit, disclosures about the assets, disclosures about the liabilities, disclosures about the main customers, right? Disclosures about the main products that derive the revenue of the particular segment. All these things are to be disclosed, right? So that's the application of SLFRS 8 in terms of the segment reporting, if that is tested in the question, right? Next up. So again, I'm telling you, I have not discussed the standard SLFRS 8. If I discuss the full standard, it takes 2 hours. You know, we don't have time to discuss, you know, every little step in detail, but I have given a summary. Again, if you can remember the stuff, that's great. If not, you have to do your homework. That's why I said that. Okay, and so to analyze the pre-scene, for me, 1 or 2 hours are not enough, right? So to analyze in the what you call in the way it is to summarize, even now I can't discuss everything here, at least to summarize it takes, you know, 5 to 6 hours. So that's why I want to have 2 sessions. We completed all the you know, theory revision, even the revision is completed by now, right? In the LMS, if you can find, if you access to the LMS today, we have 8 consolidation questions, including 4 past paper questions and 4 model questions that can be tested in the examination, 8 consolidation questions, 31 accounting standard questions, right? And there are 2 videos, important videos relating to impact of COVID-19 on financial reporting, as well as 1 more video to link the financial reporting part with the risk and governance part. That is 45% of the syllabus. That is how to use the accounting standards. So how the accounting standards will lead to risk of material misstatement. So there's a special video for that. So we have enough work to be enough work to do, right? Analyze the pre-scene, look at the question what is uploaded in the LMS, and also as I mentioned earlier, I have uploaded certain standards, the entire theory, things like financial instruments. I uploaded the entire thing in the revision folder. And also I uploaded the entire thing with regard to this standard. That's why I want to tell revenue recognition, because if you look at the past papers under the new syllabus, right? So SLFRS 9, SLFRS 15 revenue, and SLFRS 16 leases have been tested regularly, repeatedly in the examination. So because of that, so SLFRS 15 is very important standard, another important standard from the exam point of view, right? Okay, so what the relevant information here, it was given in the question, numerous frauds that took place involving 2 distributors who are no longer in the network. That means with regard to invoicing, certain frauds have been happened. Okay, so I'm not going to discuss about, okay, so what are the weaknesses in the control environment, why these frauds have been happened and how to overcome, because that is actually covered by the lecturer who is doing the risk and governance part. I'm going to take the accounting aspect of it, right? So when it comes to the accounting aspect, this invoicing means at revenue recognition. So to recognize the revenue, you know, we should be aware about the 5-step model of recognizing the revenue. And ultimately, what is the point at which you need to recognize the revenue? Whether you should follow the overtime approach to recognize the revenue, or whether you should follow the point in time approach to recognize the revenue. With regard to this question, this particular question, CAPL, it seems that performance obligations are going to be satisfied at a particular point in time, not over time, right? Anyway, so these are the 5 steps, right? You need to identify the contract with the customer. So what is the agreement between the entity CAPL and the customer? Okay, so let's say agreement to provide goods and the services. Okay, agreement to provide a good and service. The step number 2 is to identify performance obligations within the contract. Within one contract, you can have number of performance obligations. Maybe one is to, let's say, provide a product, a medicine product, right? One performance obligation, and the other performance obligation may be to provide certain services, okay, over a period of 1 year. right? So thereafter, determine the transaction price. What is the total amount that you collect from the customer by providing the performance obligations? Number 4, allocate the transaction price, allocate the full amount what you received into the performance obligations what you have identified in step number 2, right? Finally, you need to recognize the revenue once each of the performance obligations are satisfied. This is what I said that in step number 5. So for each identified performance obligation, you need to decide whether I'm going to recognize the revenue over time, over the period of time, or point in time. Okay, what it can be tested is actually the step number 5 as per the information given in this question. I don't think that examiner would test like 1 to 4, but he can test step number 5. So because as there were frauds happen, whether the company has recognized the revenue in the correct manner at the correct point, right? So over time means you recognize the revenue based on the what? Progress towards the completion of the particular performance obligation. More or less, actually, overtime is applicable with regard to the service contracts and also with regard to the construction contracts. But with regard to, by looking at the product range, what is available with this company, it seems that it has to be recognized at a particular point in time. Point in time means point at which control is passed to the customer. Then you need to be aware about, okay, what are the indicators of passing the control to the customer? Physical possession, legal title. Okay, so there are indicators with regard to the control. So whether these indicators are satisfied. Risk and rewards. Who has the risk and rewards? Whether the risk and rewards have been passed, whether the physical possession is passed, whether you have a ability to collect cash, right? So these are the indicators that provide the details about the control. So what is the point at which control is passed? So after passing that particular point, you must book the revenue. Okay, are we clear with that? Yeah. Any questions with regard to revenue, guys? Any questions? No issues. Okay, read this particular sort of information and tell me how SLFRS 9 is going to be applied to this. Read and tell me how this can be applied. Hurry up, hurry up. What area that can be tested under SLFRS 9? What area can be tested? Waiting for your answer. What is it? Okay. Concessionary loans, right? So here what they say is now they are into agricultural operation. So sometimes you can't do all the agricultural work by yourself, right? So you enter into contracts with outgrowers, right? Outgrowers means they are independent parties. They are not your employees. They work on behalf of you and they grow the item and provide it to you. There are companies who are doing this process, right? So for an example, let's say Cargill's is doing this backward integration with the outgrowers, and even CBL, Ceylon Biscuits Limited. So with regard to the product summer posture, they get engaged with a lot of outgrowers to get the corn and soya, right? So get engaged with the outgrowers. So what this company has done was they appointed many outgrowers and supported them through a loan scheme. Which means these loans might have been given at a rate which is below than the market rate. Okay, so it can be happening two ways, right? Company can arrange a banker to provide these loans. In that case, there's no issue because bank is going to give the loan to the outgrower. But what can happen is company can give because these outgrowers are small people. Why? How this can happen is because these outgrowers are small people and their credit worthiness is not that great. They can't provide the securities. So because of that, they can't go to a bank and get a loan. So where they need this support from the company. So what company has done was company has given a loan to these outgrowers, right? So when the loan is given, let's say the market interest rate, let's say these days market interest rate, let's assume minimum 20%, but you have given the loan to the outgrowers, let's say at zero interest loan for 2 years, or it can be at a reduced rate, let's say 5%, less than the market rate. What will happen? How to account for this loan? This loan is a financial asset, debt financial asset. So if it's a financial asset, what the standard says, initial measurement should be at fair value. Now, normally the transaction price, so the amount of the loan that you have given, let's say you have given a 100,000 loan, 100,000 rupees loan. So normally fair value is equal to the transaction price, amount of the loan that you have given. But if you have off market rates, not the market rates, market rate is 20%, you have given the loan at 5%, or else you have given the loan at zero interest, that is to be recovered after 2 years. In that case, what you do is your transaction price, 100,000 amount of the loan is not equal to the fair value. You have to apply a valuation technique. In the sense, what you do is you take the cash inflows, all the cash inflows that you're going to get, amount of the principal that you are going to get, amount of the interest that you are going to get, and discount that by the market interest rate. Market interest rate means 20%, and find out the fair value. So when you calculate the fair value, definitely it would be less than 100,000. So let's say it is 90,000, example 90,000. Then how do you book the entry? You credit cash 100,000, you credit cash 100,000 because you have given 100,000 loan. You debit the financial asset only 90,000 rupees. That is the fair value of the financial asset, debt financial asset. 10,000 you immediately debit to the profit and loss. It's a loss, impairment loss. So that is the benefit that you have given to the farmer. That has to be recognized as an expenditure in your financial statements. Are we clear with that? Then thereafter, this loan, what you have given, subsequently measured at amortized cost, right? Because if it's a debt financial asset, you have three categories to measure it subsequently: value through profit and loss, value through other comprehensive income, or at amortized cost. So in this case, it seems that this particular loan debt instruments to be subsequently measured at amortized cost. Are we clear? Again, I'm not going to read this, but I have explained to you, right? What is there in the slide? So here, apply this particular value on initial recognition is applied to all financial instrument, whether or not those are negotiated on arm's length basis. So you can have interest-free loans to your suppliers. Actually, farmer is one of your supplier, right? Or else you can have interest-free or reduced interest loan between the group companies. Yet again, this concept of fair valuation of off-market transactions are going to be applied. Are we clear? Are we clear? Right. Okay, moving on. What it says. See how the LKS 38 is applicable in this scenario. Right. What it says here, CAPL is planning to purchase a software to automate the process related to field and factory operations. So the company wants to what? Automate the processes relating to the field and factory operations, as a manual system is currently used. At the moment, what is used is a manual system, right? So they want to automate the processes. Then CAPL is planning to, so that is with regard to field and factory operations. So to automate. CAPL is planning to procure new enterprise resource planning software, that is ERP system. because if you look at the moment, all these factory and the field operations are happening manually. If you look at the accounting system, they use an old version of accounting system ACPAC. In the pre-scene, it was mentioned. So things are not integrated, so that proposing to go for a ERP system. That means they are taking certain steps to automate, right? That is obvious because they want to expand locally, overseas. They want to expand, right? And they want to introduce good governance system, especially with the involvement of the institutional investor, BlueRock. So that means you have to automate the processes, right? So to automate the whole operation, CFO was keen on implementing robotic process automation and business intelligence in the company. So CFO recently recruited person, Prasanna. Prasanna he wants to introduce the automation techniques like robotic process automation, business intelligence into the company. What is robotic automation? Robots do the repetitive task, not human. Now let's say there are repetitive tasks of an organization, right? Let's say preparing of bank reconciliation, right? Then taking sales orders into the system. So these tasks can be what? Done by a robot, not by people. Because why? That is very cheap and effective, because robot work 24 hours, but people work only 8 to 9 hours. Robot doesn't have a lunch break, tea break, nothing, right? So it improves the efficiency, right? Effectiveness or efficiency, especially, very fast. So then what are you going to do with the existing people? So you have to change their job scope, right? Then business intelligence, using data to make the decisions. How do you get the data or convert the data into useful information, useful insight to meet or to, face the competition? Business intelligence. So he want to introduce these things. So what is the applicable standard here? So these automation things, system changes are important not only for the financial reporting, but also from the uh, risk and the governance aspect as well, right? Actually, the lecturer who is covering the risk and governance part, so he discussed these things in detail, right, rather than me, but I just wanted to highlight, right? I just wanted to highlight. But at the very end, in addition to the financial reporting, I will give you a brief about what are the things which is important for the risk and governance aspect as well with regard to this pricing, in very brief, right? I'm not going to discuss in detail as he has already done it. But I will give a brief about that as well, right? Okay, coming back to financial reporting, applicable standard here, LKS 38, intangible assets, right? What is the definition of an intangible asset? Do you remember? Identifiable non-monetary asset without having a physical substance. Identifiable non-monetary asset without having a physical substance. So software. So most of the software are classified as an intangible asset, but you need to be careful about one important matter, especially when you are accounting for software. That is, look at this carefully, right? Look at this carefully. What it says is, there are certain software which are integral part of the hardware, which means hardware cannot be operated without having this software. Example, let's say if you look at a production line, now they are talking about automating the field and the factory operation. Now, if I take the factory operation, let's assume you introduce a new machinery, automatic driven machinery. Now, within this machinery, there should be a computer program, right? That particular computer program which is installed within the machinery, my question to you is it part of machinery or is it an intangible asset that has to be separately recognized? Answer to the question. No? Do you get my question? So you automated the factory operation by having automated machinery system. So within this machinery system, there's a computer program which controls the operation of the machinery. So that particular computer program, is it a intangible asset or is it property, plant and equipment? What do you think? Arya, very easy question again. Is it machinery or PP&E or else intangible asset? Answer is very simple. If you go to the next slide, some computer software is an what? Integral part of the related hardware, which means hardware cannot be operated without having that software, right? In this case, the computer program included in the machinery is a what? Integral part of the hardware. Machinery cannot be operated without having that software. In that case, that particular software is a part of PP&E, not the intangible asset. For example, computer program here in a production line robot is a integral part of the hardware, so that it is considered as PP&E. Applying this to the real life scenario, let's say you have computers, right? All of you are using computers. So operating system in the computer, let's say Windows operating system in the computer. Is it an intangible asset or is it part of PP&E, part of computer? Yet again, the same logic. Computer cannot be operated, cannot be functioned without having the operating system. Then operating system is an integral part of the hardware. So it is what? Property, plant and equipment. Right? Property, plant and equipment. So the hardware will not work without the software. Then the software is capitalized as a part of hardware and should be capitalized as a part of hardware and should be treated as a tangible non-current asset under LKS 16. Got it? Right? But if it is a standalone software, now if I go back, ERP system, that is a standalone software. To run the hardware, you don't need to have a ERP system. And even things like this robotic process automation, BI, business intelligence, these things can be what? Standalone software. Those can be recognized as a what? As an intangible asset. Are we clear with that? So if it's an intangible asset, you initially measure at cost and thereafter you do the subsequent amortization. Right? Are we clear? Is that clear? Got it. So the standalone computer software, things like accounting packages, are an intangible asset subject to LKS 38. Right. Okay. Next one. Read this and see what are the applicable standards. Okay, what are the applicable standards here? Right, what it says is this particular company, the increase in asset was mainly due to the construction of the research and the development center. Company has, so if you look at the financial statements, PP&E value has gone up. That is mainly due to the construction of the R&D center. Main fixed asset item procured relating to the building construction, then the plant and the lab equipment and tools, right? So these are the PP&E items. Current capacity of the existing factories were increased. So the existing factory capacity is also increased. A few obsolete plant and machinery were disposed during the financial year 21-22, right? So there are many areas to which this particular information has a link, right? But initially, setting up the R&D center is covered under LKS 16, property, plant and equipment, right? And also company has expanded the existing factory capacity. That is also coming under property, plant and equipment, expansion work, right? So, so here, if you look at the theory part, what is it? PP&E initially measured at cost. So whatever the amount that you incur to construct this R&D center, as well as to expand the existing factory capacity, you have recognized as PP&E. So the initial measurement should be at cost. When you are measuring the cost, you should know what items to be included within the cost and what it has to be eliminated out of the cost. So the cost comprise of first one, purchase price or the construction cost, that is direct. Then any cost directly attributable to bring the asset into the location and the condition for the intended use. So now if I take an example, let's say if I import a machinery, right, in addition to the machinery purchase price paid to the supplier, things like, freight cost, insurance cost, custom duty, bring in the machinery from port to my warehouse, there's a cost. All these things are included, right? And finally, if you any estimated cost of dismantling or removing the item and restoring the site, that cost also to be included. For an example, let's say this particular machinery, I'm expecting to use that for 10 years. At the end of the 10 years, I'm going to dispose this machinery. That is a complex machinery. Disposal process of this machinery would cost me some amount of money. What I'm going to do is I'm going to calculate what is the present value of that future dismantling cost, present value of the future dismantling cost. That cost also I recognize as a cost of PP&E, debit the PP&E, credit to a provision account. So these are the three items which are included within the initial cost of the PP&E item, right? And also the period of including the directly attributable cost, especially with regard to this particular point. What is that? Because standard says that cost can include directly attributable cost, bringing the asset to the current condition and location. So under that particular point, you should know when you should initiate capitalizing the cost and when you should stop. What is the point that you should initiate? When you initiate the purchase transaction. Normally, how do you initiate a purchase transaction? Now, let me give an example. Let's say you want to get some machinery for this research and development center. Okay, this can be a question, right? Because even though it's not when you read the question, you don't directly see, okay, that can be tested, but examiner can introduce that as a separate scenario. Let's say certain plant and machinery items are imported from foreign countries. And what this company has done was they sent a team to inspect the machineries of few foreign suppliers, right? So then they sent a team of 5 people, and they have gone there, and so company had to spend on their air ticket, accommodation cost was incurred, and they came back. Okay, they visited 5 factories of the foreign suppliers. They came back, and then they have done the evaluation and selected, okay, I'm going to go ahead with this particular supplier. What I'm asking, the cost what they incurred for that foreign travel to visit 5 suppliers, can you capitalize? Can you capitalize as directly attributable cost? No, you can't. Because why? You have not yet initiated the purchase transaction. You have not yet initiated the purchase transaction. You initiate the purchase transaction only once you select one out of the 5 suppliers and you raise the PO. What is PO? Purchase order. You raise the PO to that particular supplier. I'm going to get the machinery from him. That is your starting point of capitalizing the cost. Similarly, you should stop capitalizing once the asset is capable of being operated as intended by the management. Once the asset is ready for use, capable of being operated as you intend, you have to stop capitalizing. Because after the construction, now if you look at the balance sheet of this question, there are some work in progress items, right? So work in progress items, you should really look at, okay, actually they are work in progress or not, because sometimes you complete the activities, but you have not start the actual operations because you are waiting maybe up until auspicious time to come. Okay, so but the activities are completed. It can be operated as intended by you for the business purpose, but you have not utilized it actually. What I'm telling is you should cease capitalizing the cost once the asset is ready for use. You can't wait until the actual operation starts. Okay, is that clear with you? Is that clear with you? Then asking another question, let's say this is a complex machinery. You went to a foreign country, you met 5 suppliers. Out of that, you selected one supplier, and the machine is getting constructed. It takes 6 months time to construct. Certain machinery items are constructed for 6 months period. Complex machinery. Now during the construction process, after now it takes 6 months. After 3 months, to see that whether the machinery is in the required standard by the particular organization, CAPL sent another team of people, engineers, to look at whether the machine is up to the standards. So they also went, they spent on traveling, they spent on accommodation, there's a cost. Now, my question is, can we capitalize that cost as a part of directly attributable cost? Can we capitalize that cost? Yes. Because why? Now the purchase transaction is initiated. They go there to look at this particular machinery. So that is a directly attributable cost. So that can be capitalized. And also you need to be careful now. Directly attributable cost means these costs are incurred for this purchase. If not for the purchase, these costs are not going to be incurred. Now, example, procurement department salary. So you can say that, okay, procurement department is getting involved in the machinery importation. They are the one who prepare these documents, lot of work, they get involved in the custom work, so that I'm going to allocate part of their cost to this particular machinery. Can you do that? No, that is not a directly attributable cost, because even though this machinery is not purchased, still you need to incur that cost. Those cannot be included within the machinery cost, right? It has to be directly attributable. If not for the purchase, that cost is not going to be incurred, right? So that is with regard to the capitalization of cost. And also here it was mentioned the one of the factory got expanded. So which means again, so expansion means your production capacity has gone up. So now to decide whether to capitalize, so to decide whether to capitalize a particular cost or to expense that particular cost to the P&L is depending on whether the recognition criteria of PP&E is satisfied or not. What are the two recognition criteria of the PP&E? Future economic benefits are probable and cost can be measured reliably. Obviously, based on the information given, so with this expansion, capacity, number of units that you produce will increase. So in that case, the cost you can capitalize, right? Cost you can capitalize. So there should be an additional economic benefit out of that. It can be capacity increase, it can be an increase in the quality of the output, it can be a reduction in per unit cost, it can improve the quality of the product. In somehow or the other, this particular expenditure, subsequent expenditure should generate additional economic benefits, then you can capitalize that cost, right? So I think this particular cost, capacity expansion, you can capitalize. Then finally it's mentioned here, few obsolete plant and machinery were disposed during the year 21-22. Disposal, at the time of the disposal, you have to calculate the disposal profit. That is simple and straightforward. You compare the sales proceed with the carrying value, calculate what is the profit or loss that has to be included in the P&L. In addition to that, if you look at the balance sheet of this company, it has a revaluation reserve. It has a revaluation reserve. You need to clearly look at whether the items that has been disposed are carried at revaluation model. Okay, if it is carried at revaluation model, what you need to do is, once the item or the PP&E is derecognized, relevant revaluation reserve also you need to transfer to the retained earnings. Okay, with the derecognition of the item, if you have a revaluation reserve with regard to that item, that also to be transferred to the retained earnings. You can't transfer that to the P&L, that has to be transferred to the retained earnings. Okay, so the point is this particular last point. If revaluation model is used, remainder of the revaluation reserve relating to the asset should be transferred to the retained earnings. There's a question with regard to disposal of non-monetary asset which is kept at revaluation model. Yet again, if you have a revaluation reserve created with regard to non-monetary asset, So if you dispose the item, what you do is that has to be again transferred from the revaluation reserve to the retained earnings. Okay. Right. Yeah, so there are a few more slides to actually complete this particular tutorial or the handout. So what we can do is we can today we can actually stop at this point. What you need to do is actually remaining slides, please go through by yourself, because I have explained the relevant application of the pre-scene like this. So this is one, and over here another one. Okay, finally about the automation and the governance and risk related matters, right? So the remaining parts, what you can do is go through by yourself, right? What we can do is we can have the latter part of this tutorial plus possible consolidation questions that can be tested in the examination. We can discuss that in the second session, that is to be held on this Sunday from 9 to 12. We'll discuss there. So because it's 3 hours, okay, difficult to focus when it comes to online class, especially if it's a physical class, no issue. But as it's online, the effectiveness will be reduced. So that's why, so what we can do is we can discuss about the remaining stuff on Sunday together with the consolidation, because consolidation won't take that much of a time. It takes, like 1 hour. So I can complete this part within 1 hour. Then we can focus on consolidation 1 hour. Then finally we can think of exam tips and tricks, because that would be our final class before the examination. Okay. Right.